area. We can't be able to cover all these. I want us to just have that particular discussion using a question, because this is something you're able to do in PF2, but basically we'll be able to remind ourselves maybe what we need to remember. What do we need to remember? I think I'll be able to remind you on that. Yes, so let me share something here. I think I've seen Kezia asking about the question. So the document which I'd shared with you, the question is there, though I think the question is having a solution. So maybe you can just look on it, but the question is within the document, within the Excel document I shared with you, within the Excel document which I shared with you yesterday. So this is basically the question I want us to do. Is one of the questions which was I think tested in BDA. I can't be able to remember the exact sitting, but I think is one of the most recent sittings. So what are we told here? We are told Wakili, Safari, and Firamu trade as Wasafi Enterprises. The following is a summary of the statement of profit or loss for the business for the year which ended 31st of December 2022. So we're given a summary of the statement of profit or loss. We have the gross profit, and then we have investment income. We have other incomes. Then we have expenses, administration expenses, legal fee, trade expenses, depreciation, partner salaries, interest on capital. We have other expenses, and then we have the net profit. Then we are given some additional information here. One, we are told the investment income comprises of the following. So I hope you can remember up here we had investment income. This investment income here, we are given basically a note for that, and I think that is note number 1. We are told this investment income comprises of what? Comprises of interest on bank deposit, dividends from investment in listed companies, interest charged on partners' drawings. And then you're told the interest charged on drawings is as follows: Wakili 1 million, Safari 800,000, Firamu 400,000. Number 2, you're told other incomes include the following. So other incomes still, these are part of incomes within the statement of profit or loss. These other incomes here. We are given some information in relation to this in note number 2. And we are told other incomes comprises of the gain on sale of old furniture, insurance compensation for cash lost. Number 3, we are yes. So I want us to continue. I want us to look on this question here. I hope you already have it with you. Do you have this question with you? If yes, please confirm. If yes, please confirm so that we can start. Do you have this question with you for December 2021? If yes, please confirm so that we can start. Okay. So what are we told here? What are we told? So what are we told? This is the question number 5. And the question is, the following trial balance relates to Babu Limited as at 31st of December, March 2021. So we're given a trial balance there. And the first item you're given is the ordinary share capital, the share premium, the retained earnings, property at cost. And then we have the plant and equipment accumulated depreciation on 1st April 2020 for buildings, plant and equipment, inventory as at 31st of March 2021, trade receivables, bank overdraft, deferred tax, trade payables, current tax, revenue, cost of sales, distribution cost, administrative expenses, dividends paid, bank interest. Then we have some additional information, number 1 all the way to note number 4. And then from there, what are we required to do here? We are required in Roman 1 or part A we prepare the statement of profit or loss for the year which ended 31st of March 2021. And part B, we are required to prepare the statement of financial position as at 31st of March 2021. So we are going to start with basically Roman 1, but even before we prepare what is required, it is important for us to go through the additional information, number 1, all the way to note number 4. We see, are there some workings which are required? If there are some workings which are required, that's basically what we are going to start with here. So in note number 1, what are we told? We are told that on 1st of April 2020, it is important for you to note that 1st April of 2020 is the start of the current year. If you go to the requirement, you'll be able to see that we are required to prepare financial statements on 31st of March 2021. This is when the year ended. So this year started then when? On 1st of April 2020. That is the start of the year. This is basically the end of the year. So what we are told in note number 1 is that on 1st of April 2020, which is the start of the year, the directors of 𝐉𝐎𝐻 Limited resolved that the financial statement would show an improved position if the property was revalued to market value. At that date, an independent valuer valued land at shillings 160 million and building at shillings 485 million. The remaining life of the building, as at that date, was 25 years. And then you're told 𝐉𝐻 Limited does not make any transfer to the retained earnings for excess depreciation. In that case, we are told to ignore the deferred tax on the revaluation surplus. So as far as that point is concerned, point number 1, we are told the company revalued 2 assets: revalued land, revalued building. Anytime the company value assets, we need to determine, was there a revaluation gain or a revaluation loss? That is the first thing we need to do here, and that would be our working number 1, whereby we need to determine the revaluation gain or basically loss on the property. Remember, the asset which was revalued here is the property. And actually, there is something I mentioned, I don't know whether in our previous class, whereby I say that if you're given property usually comprises of 2 assets. A property usually comprises of 2 assets. Property comprises of buildings and also land. If you come across this usually comprises of 2 what? Assets. So how do we compute the revaluation gain or loss for these 2 assets? So we will compute the revaluation gain or loss for buildings and also for land. So to compute this revaluation gain or loss, we compare 2 values. We compare the revalued amount. Our assets were revalued at how much? And then we compare this with the net book value. In case an asset is being depreciated, if an asset is not being depreciated, we compare that with what? With the cost. Like generally what we know is that we don't depreciate land. So therefore, in computing the revaluation gain or loss for land, we will compare the cost with the revalued amount. But for buildings, mostly these ones are being depreciated. So we compare the revalued amount with the net book value. So let's first of all, we have the revalued amount, because the revalued amount, we have them in additional information number 1, sentence 2. At this date, an independent valuer valued land at shillings 160 million. So this one was revalued to 160 million. Whereas buildings were revalued to 485 million. So then what we need to do is we go back to the trial balance. In relation to all for land, we need to determine what is the cost for land, because we know land is not depreciable asset. And then for building, we need to determine what is the net book value at the start. So let's go back to the trial balance, specifically where we have property. Property is the 4th item in the trial balance. From the top up there, we have property. And basically, you're told that this property, we are given the value as what? 732. And also, in this case, for us to be consistent, let's work with these figures in thousands of shillings, like this. We work with all our figures in thousands of shillings for us to be consistent. So mean that RAD here, RAD was revalued to 160 million, which in thousand of shillings will be 160,000. This one was revalued to 485 million, like that, in thousand of shillings. So for the property which is in the trial balance, this is the property. We are told property comprises of RAD, and basically I hope you can see we are told that the cost of RAD is 146 million. 146 million. So meaning that the difference here will be the cost of buildings. So what is the cost of buildings? This minus 146. We try to hurry up because this question we must finish. We must finish this question here. Yes, I'm told by Helen that this one will be 586,000. So that is the cost of buildings. Now in this case, still if you check just below the property, we have plant and equipment, and below that we have accumulated depreciation. So we're given the accumulated depreciation for buildings. So you can see these buildings are being depreciated. So I've said in computing this revaluation gain or loss, we will compare the net book value of the building, this one, with the revalued amount. But for land, we'll compare this revalued amount with the cost. So the cost of building, sorry, the cost of land is 146. We don't depreciate what? We don't depreciate land. So what will be the net book value? The net book value, because whatever you have here is the cost. The net book value of an asset we know is equal to the cost minus accumulated depreciation. So the cost of building is what we have here, 586,000 minus the accumulated depreciation in the trial balance. So what is the accumulated depreciation for buildings within the trial balance? I hope you can see that below plant and equipment, which is 122,000. So this will give us what? A net book value of what? A net book value of what? This will give us a net book value of 484,000. 484,000. Is that what you're getting? 484,000. And please let's participate in class. Mwalimu need to get the answers here. Let's please participate in class. Once you get the answer, type it in the chat box. I need to see you participating in class. I need to see you participating in class. Once you get the answer, type it in the chat box. Type it in the chat box. Yes, that will give us 464,000. So having this, then we can be able to move and we determine, do we have a revaluation gain or loss? Remember in this case, for you to determine whether you have a revaluation gain or loss, basically you need to compare these two values. And if the revalued amount, this one is more than the cost of the net book value, we have a revaluation gain. If the revalued amount is less than the cost or the net book value, that is the revaluation loss. Basically, I've said if this is more, is a revaluation gain. If this is less than this, is a revaluation loss. And I hope you can see this is more than this. Equally, this one is more than this. So it means that here we have a revaluation gain. So what is the revaluation gain here for land? Because the cost of land was 146, but land was revalued upward to 160 million. So you have 14 million. 14 million. What about buildings? Buildings had a net book value of 464. They were revalued upward to 485. We have a revaluation gain of how much? Of 21. Now, this revaluation gain, when preparing our statement of profit or loss, as required in Roman 1, this one will be captured there as part of OCI. And OCI in full and the other comprehensive income. And the other comprehensive income. And still, when preparing the statement of changes in equity, this revaluation gain will be taken to the column for the revaluation reserve. Then still in note number 1, there is something else we also need to compute. I hope you can see in sentence number 3, we are told the remaining life of the building is at that date. At the date the building was revalued was 25 years. So why are we given the remaining useful life of the building? That is given to help us in terms of computing the depreciation per annum of what? Of the buildings. It is important for you to note that once the asset has been revalued, in computing the subsequent depreciation, In computing the subsequent depreciation, we use the revalued amount. In computing the subsequent depreciation, we use what? We use the revalued amount. So we will compute the depreciation for this building for the current year using the revalued amount. The revalued amount is this one, 485. And once we are given the remaining useful life, we divide this with the remaining useful life. The remaining useful life of the building are 25 years. 25 years. 25 years. So this will give us what? This will give us depreciation per annum of how much? Juliet is saying my board is not clear. Is that the position? Is that the position? Is my video okay from your side? Is Morimu's video okay from your side? Yes, but I think it is improving slowly. It is improving slowly. So therefore, what I've said is that we are given this remaining useful life for us to be able to compute the depreciation on buildings. So the depreciation on buildings, I think I've seen that figure being 19,400. And this one, unless told otherwise, we have said should be included within the cost of sales. Within the cost of sales, unless told otherwise. So that's basically what we are required. Let's move to note number 2. We are told that depreciation, our plant and equipment is depreciated at the rate of 15% per annum using the reducing balance method. All depreciation is charged to the cost of sales, and none has been charged on any non-current asset for the year which ended 31st of March 2021. So what we need to do is we compute the depreciation. In note 2, we compute depreciation on plant and equipment. Plant and equipment. And basically the depreciation on plant and equipment, this one will be equal to what? This one will be equal to 15%. So which method is being used by the company? The reducing balance. You have to recall, under the reducing balance, we compute depreciation based on the net book value, based on the net book value, based on the net book value. So the net book value here will be equal to the cost. That's basically what you have said here. The net book value is equal to the cost minus the accumulated what? Depreciation. So therefore, we take the cost of our plant and equipment in the trial balance, which is basically below the plant, which is 427,000, minus the accumulated depreciation, which is 85,400. So we get, first of all, the difference here. Then we compute what? We compute 15% of that. So what are you getting here? 427 minus 85,400 times 15%. Yes, what are you getting? What are you getting? What are you getting? What are you getting here? What are you getting? Zipporah, what are you getting? What are you getting? What are you getting here? Yes, so 51 to 40, and also record what you're told. All the depreciations should be included as part of the cost of sales. And actually, depreciation for the current year was not yet computed. I think my video now is clear. Is that the case, Erin? Is my video clear now from your side? I can see it has improved. It has improved. Okay, so then we move to note number 3. Remember, in our previous class, we did something in addition to note number 3. So we'll be able to move that a little bit fast. We are told Babu Limited estimated that income tax provision of shillings 113.8 million is required for the year which ended 31st of March 2021. So meaning that during the current year, the estimated tax liability, the estimated tax to be paid during the current year is 113.8. And then you're told in paragraph 2, the balance on the current tax in the trial balance represent other stroke over provision of the tax liability for the year which ended 31st of March 2020. So if you can be able to recall, in the trial balance, we have something called the current tax. Can we go back to the trial balance? You tell me how much is that current tax? And the current tax in the trial balance, it got very fast what we did in this question, what we did in relation to that note. The current tax in the trial balance, how much is that? That is basically a figure of 12,800. Now, what you are told in note number 3, specifically sentence number 2, this amount is over or under provision of current tax in the previous year. Over or under provision of current tax in the previous year. Remember, you said the examiner, if in the previous year there was over or under provision, the examiner will not specifically tell you whether it was over or under. It's upon you to be able to recall. And actually, we said you need to check whether this balance in the trial balance is a debit balance or a credit balance. So we said if this is a credit balance, it appears on the credit side, it is automatically over provision. If it is on the debit side, it is under provision. And therefore, take into account this particular balance is on the credit side of the trial balance, we say that this one is over what? Over provision of the current tax in the previous year. So this over provision of current tax in the previous year, we said it should be brought forward to the current financial year and be deducted from the estimated tax liability. So therefore, because in paragraph 1 of note number 3, we are told that 𝐉𝐎𝐈 Limited estimated that income tax provision for current year is 113.8. So the company estimated during the current year, it was supposed to pay tax of 113.8. So therefore, to compute the current tax which will be charged or which will be taken to the income statement, we said we take the estimated tax liability for the current year, this one, and then we less the over provision from the previous year, this one, which is we less, this one will be equal to 113,800 minus this 12,800. So this will give us 101,000. So this is the current tax which will be taken to the income statement, The estimated tax liability minus the over provision. Then let's move to the last paragraph of note 3. And we are told that as at 31st of March 2021, that is the end of the current year, the tax base of 𝐉𝐴 Limited net asset was 292 million less than the carrying amount. The income tax rate is 30%. So that 292, we said is the difference between carrying amount and net asset. That is carrying amount and tax base of the company's net asset. In other terms, this is the temporary difference. This is the temporary what? A difference. And specifically what you are told is that the tax base of the net asset of this company was less than carrying amount with an amount of 292 million. So remember what we said in our previous class. We said we have two types of temporary difference. The taxable temporary difference and deductible temporary difference. We said a temporary difference is taxable whereby the carrying amount exceeds tax base. And a temporary difference is deductible whereby the carrying amount is less than tax base. And we say this one, taxable temporary difference, result to something called deferred tax liability. This one result to something called the deferred tax asset. This what you just need to recall from what we discussed in our previous class. So what we need to do is to determine whether this temporary difference, is it taxable or is it deductible? And because we have the word tax base before, we can start with the carrying amount. And then we said we will change this inequality sign from less than to greater than a tax base. So mean that the carrying amount is greater than tax base with the 292,000, which automatically means that this is a taxable temporary difference. This is a taxable temporary difference. So if it is a taxable temporary difference, we need to compute something called a deferred tax liability at the end of the year. So the deferred tax liability at the end of the year will be equal to the taxable temporary difference, this one, times what? Times the tax rate. Times the tax rate. And the taxable temporary difference is 292,000 times the tax rate, which is given in note number 3, the last sentence, 30%. 30%. So this will give us what? And I think we computed all these figures. This was coming to a figure of, was it 90 what? 87. 87,600. 87,600. So having this, then we said, because these are deferred tax liability at the end of the year, we need to compare that with the deferred tax liability at the start. The deferred tax liability at the start of the year is basically what we have within the trial balance. If you go to the trial balance, you'll be able to see we have a deferred tax what? A deferred tax liability. So we have the deferred tax liability at the start, which is in the trial balance. And then we have the deferred tax liability at the end of the year, which we have computed here. The one which we have computed here is 87,600. And the deferred tax liability which we have in the trial balance is how much? Can you see the deferred tax liability in the trial balance? Who can see that figure? Who can see that figure? Yes, that figure I'm given by Helen as is it Helen or Zipporah? By Zipporah as 97,600. So we said compare the deferred tax liability and the deferred tax liability at the start and also at the end, and then you determine, do we have an increase or a decrease? So this basically is what? Is a decrease. Is a decrease. So we have a decrease in deferred tax liability. And actually we said a decrease. This one is a deferred tax income. In preparing our income statement, that is a deferred tax income of how much? Of 10,000. So that is basically what we are going to account for in the income statement. So let's move to the last note. Note number 4. We are told Babu Limited made 145 bonus issue on 31st of March 2021, which has not yet been recorded in the books of account. The company intends to utilize the share premium as far as possible to provide for the bonus issue. So we are told in that case, the company made a bonus issue. What is a bonus issue? A bonus issue basically, this is where the company issue shares free of charge to the existing shareholders. So we have said that once the company make a bonus issue, these shares will have to be paid for by the company using one of the reserves. So therefore, we are told that the company made 145. In other terms, what that means is that during the bonus issue, the company was to issue one share for 5 shares which were held. That is the interpretation of that, 1 for 5. The company was to issue one share for every 5 shares which were held. Now, what we need to do here is we determine how many shares were held before the bonus issue, because we are told the bonus issue was not accounted for. To determine the shares which were held before the bonus issue, we go back to the trial balance. The first item, where we are given the share capital, we need to compute how many shares had been issued by the company before the bonus issue. We will take the share capital, which is 560. We divide that with the par value per share. I hope you can see still in the trial balance, the first item, inside the bracket, you're given the par value, which is 10 bob. So meaning the shares issued by this company are 56,000. So these are the shares which were held. So for us to determine the shares issued during the bonus issue, we cross multiply, then we divide. So we have 1 times 56,000 divided that with 5. This will give us how many shares? This will give us how many shares? This will give us 11,200 shares. It is also important to know that anytime the company is issuing shares during a bonus issue, shares are issued at their par value. So therefore, the shares issued during this bonus issue, they had a value of 112,000. So this 112,001 will increase the ordinary share capital. The ordinary share capital of the company will increase. When preparing the statement of changes in equity, this one we added to the share capital. And then because the company utilized the share premium, the company paid for these shares using the share premium. The share premium will reduce with 112,000. And I think now having those workings, we can proceed and prepare what is required. We will start with part A. We start with part A, whereby we are required to prepare the statement of profit or loss of this company. The name of the company is 𝐉𝐎𝐈𝐍 Limited. And this is what? This is a statement of profit or loss. This is a statement of profit or loss, basically which is for the year which ended 31st of March 2021. 31st of March 2021. Now, remember, we have said that in preparation of this, we have a single column here. In this case, we don't use 2 or 3 columns. We just have a single column, just one column. So, and then here, now for you to be able to prepare this, you must record the format which I've given you. We have said here we start with this, with the revenue. With the revenue, in very rare cases, this can be known as sales. But at this level, the examiner will give you what? The examiner will give you what? The revenue. The revenue. One share is 10 shillings. The value is in 1,000. The share will not be divided by. Remember, Virginia, here, for you to be consistent, all our figures are in 1,000 of shillings. In 1,000 of shillings means that in any of the figure we have here, we have omitted the last 3 zeros. That's basically what you have to do for you to be consistent. Yes, for you to be consistent. This figure, we have omitted the last 3 zeros. Here we have omitted the last 3 zeros. The actual number of shares are not 56,000. It should be 56 million. Are we together, Virginia? Yes. All the figures here, because we want to be consistent. We don't want some figures to be in full, some figures to be in thousands, and some figures to be in millions. That's why even here we didn't work with the millions, we worked with thousands. So for us to be consistent. Okay, so where do we have the revenue? The revenue, we have it in the trial balance. And then we say there's a very important acronym which I gave you in our previous class. We say this acronym is very important, especially in these topics. The acronym of DIRA. We said this one stands for drawings. We said companies may not have drawings, but this one stands for expenses. This one stands for expenses. This one stands for assets. We say these 2 items in the trial balance, they have a debit balance. If you're looking for asset or expense, you get it on the debit side of the trial balance. This one stands for liabilities. This one stands for equity. This one stands for revenue, or basically incomes. And we said all these items, they have a credit balance. We know revenue is an income. So when checking for income, you check it on the credit side of the trial balance. So the revenue, and basically that one do not have any adjustment. This one is a figure of 2779, 160. So to this, then what do? We less the cost of sales. Now the cost of sales, this one is given within the trial balance, just below this revenue, and it is given as a figure of 2,200,6,900. But basically, we know there is some adjustment to be made to that cost of sales, simply because this depreciation on buildings, this depreciation should be added to the cost of sales. So we will make that adjustment here within the bracket. 2006, 900, and then we add this to depreciation. 19,400, and this other one for plant and equipment, 51,240. We get the final figure. We take it now to the last column there as a deduction. So this will give us what? So we have 2006, 900 plus we have 19,400 plus 51,240. So that will give us a final figure here of 2,077,540. So we less that from our revenue. So our revenue is 2,779,160. And basically we get what? We get the gross profit. We get the gross profit. So how much is the gross profit? 701. 701 what? 620. Yes, I hope that is what you're getting. So then to this, we have said we proceed and we add other incomes. We add other what? Income. So basically, in this case, when checking for other incomes, we should go back to the trial balance. And basically, in this case, we have said all incomes, including revenue, they have a credit balance. So check the items appearing in the last column of the trial balance, whether you have any other income. So we check the items on the credit side. Up there, you can see we have ordinary share, capital share, premium, retained earnings. All those that we know are items of equity. And then down there, I'm only checking the items in the last column here. Down there, I can see accumulated depreciation for buildings, plant, and equipment. Those are not incomes. Down there, I can see we have bank overdraft, deferred tax, payable, current tax, revenue. So it basically means that in the trial balance, we don't have any other income. So we proceed and we get the total, which remain the same, total incomes. So these are total incomes. Total income. So to this then, recall we have said we proceed and we less the expenses. So for the expenses here, we have like four. The distribution, admin, finance cost, and other expenses. Another word, expenses, and other expenses. So let's go to where we have this cost of sales. Below the cost of sales, within the trial balance, I can see we have the distribution cost, and distribution cost is for the workings which you have done here. This expense do not have any adjustment, no adjustment to be made here. So we use the figure given in the trial balance, 164,700. So then below that, we have the administrative expenses. The administrative expenses equal this one will not be having any adjustment. So and that is 201,300. No adjustment here. So below that, we have dividends. Dividends basically is not an expense. This will go to the statement of changes in equity. Then below that, I can see bank interest. Bank interest, this is the interest charged by the bank, maybe as a result of overdraft, as a result of loans. So that is part of the finance cost. So we don't include it here as a bank interest, but we include it here as part of the finance cost. So the finance cost in our case will be 10,980. Then we need to check whether we have any other expense. Any other expense. Remember, you have said in other expenses. These are the other costs of the company, the other expenses of the company, which do not qualify to be classified as part of cost of sales, distribution, admin, or finance. And actually, we have said when checking for the expenses within the trial balance, we check the items appearing on the debit column. Can we go back to the trial balance? Specifically on the debit column, we see, do we have any other expense? Up there, you can see we have a property, plant, those are assets. Down there, you can see we have inventory receivables, those are assets. And then down there, we have cost of sales, distribution, admin, dividend, interest. So we don't have any other expense. And equally, if you check on what we have here, I think you have dealt with this. You have dealt with this. So these taxes, the current and deferred will be deducted from the profit after tax. So mean that in our case, we don't have any other expense. So what we need to do is basically we get the profit. We get the profit before tax. So let's get this profit before tax here. The profit before tax. So it will be 701,620, this one, minus the three expenses. What are you getting here? Who is able to compute that figure? Who has computed that figure? Who has computed that figure? Yes, I'm given by Zipporah. 326 to what? 324, sorry. 324, 6 what? 640. So having that then, I've also received the same from Juliet. Okay. Yes, so having computed that, we need to proceed and we let the income tax expense. Income tax expense. Income tax expense. Remember, you say that this income tax expense basically comprises of two components of tax. This one is the current tax which is here, and the deferred tax. So here we will have number one, the current tax expense. The current tax expense is what we computed here of 101,000. We less it from this, and then we have this one, deferred tax income. So the deferred tax income, because this is an income, this one we added to the profit. The amount of 10,000. The amount of 10,000, this one will be added to the profit, not to be deducted because it's an income. It's supposed to be added. But if it was a deferred tax expense, we less it. And then we get the profit for the year. We get the profit for the year. The profit for the year. So we take 324,640 minus 101 plus 10,000. I'm getting what? 233, 640. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes, that is confirmed by Felix. Confirmed by Felix. Yes. So then we have said after getting this, we proceed and we add other comprehensive incomes. We basically proceed and we add other comprehensive income. So the other comprehensive incomes, we said that we have two. We have this revaluation gain on land and buildings. So we have the revaluation gain on buildings and also what? Land. So the revaluation gain on buildings is 21,000. For land is what? Is 14,000. Then we get the total comprehensive incomes. We get the total comprehensive incomes. The total comprehensive incomes. You can see that far edge. Sorry for that. Okay, you should be able to see that far edge now. Okay, so then we get now the total amount there plus the 35,000, which will give us 268, 640, 268, 640, 640. Yes. So that is it. Are you getting that? If you're getting that, just confirm. Are you getting the same? Yes, that is confirmed. Now, I want us to move to, to the last part. But before we do that, I want us to prepare the statement of changes in equity, though it's not a requirement in this question. So the figures we are going to get here, we will use them in preparation of the statement of financial position. So let's prepare this one, though it was not a requirement of the question. So remember, you have said this one, we prepare it to show, or basically to adjust the items of equity. So here we start with the details column. And then which items of equity do we have in our question here? We will start with the first item in our trial balance, which is the ordinary share capital. So below that we have share premium. Below that we have share premium. Below that we have the retained earnings. The retained earnings, those are the 3 items of equity. And I think in the trial balance, we don't have any other because we don't have general reserves, we don't have the revaluation reserve. But basically, from the workings which you have done here, we know that during the current year or at the start, the company revalued land and buildings. So this revaluation gain will be taken to something called the revaluation reserve. The revaluation reserve account. Then we have the total column. The total column. So then what do we start with? We start with the opening balances, and we must also indicate our figures will be 1,000 of shillings here. So we will start with the opening balances, and basically the opening balances are the figures we have in the trial balance. So the ordinary share capital is 560,000. Share premium 160,000. I'm taking the figures we have in the trial balance. The retained earnings is 241, 560. And then in that case, we didn't have the revaluation reserve at the start. Then we get the totals, we take them to the last column. We have 560 plus 160 plus 241, 560, which will give us 961, 5 what? 560. I hope that is what you're getting. Then to this, now what we need to do, we need to take into account the various transactions which occurred during the current year and which affected these items of equity. I think we can start with what we have here. Working 1, we have the revaluation gain, and this one we split it. The valuation gain on buildings, and the revaluation gain on land. This one will be taken to the revaluation reserve column. This column here. This column here. Land was revalued upward with an amount of 21. That is, buildings were revalued upward with 21, and land was revalued upward with 14,000. So then from there, what else do we have? Do we capture here? This will not affect that, but we have this bonus issue. Bonus issue. So the bonus issue we have said will affect 2 items. The ordinary share capital will increase with 112,000, whereas share premium we reduce with the same amount of money. So that will not affect any other column. And equally, if you take this plus that, it will give us 0. No amount will be taken to the total column, but for these 2 items, that will go to the last column, the total column. The same case with this 14,000. The same case with that 14,000. So then from this statement of profit or loss, what do we capture here? The profit after tax. Profit after tax, this one, or the profit for there. This profit after tax goes to the retained earnings column, this one. 233, 640, and then we take it to the last column, 233, 6 what? 640, 640 like that. Then there is something else we need to capture here from the trial balance. And I hope you can remember the second item from the bottom of the trial balance. We have dividends which were paid. We say dividends are paid from the profit. So the dividends which were paid, this one will be deducted in this column for the retained earnings. Dividends paid were 24,400. 24,400. Yes, so, and basically that also go to the last column, 24,400. So I think in our case, we are basically done. So what we need to do here is we get the balances. We get the balances at the end of the year. And these balances at the end of the year, we then transfer them to the statement of financial position. We transfer them to the statement of financial position. So we can start with the ordinary share capital, which will be 560 plus 112. And that will give us 672,000. 72,000. What about the share premium? we have 160 minus 112, which will give us 48,000. What about the retained earnings? The retained earnings column, we have 241,560 plus the profit after tax 233,640 minus the dividends which were paid 24,400, which will give us 450,800. So what about the revaluation reserve? Here we have 35,000. 35,000. What about the total column? The total column, we have 961, 560 plus 35,000 plus 233, 640 minus this one is a deduction, is a negative, is a deduction, minus 24,400. So this will give us 1,205,800. 205,800. Is that what you're getting? 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 Do we prepare this? Do we finish this question? It will take us like the next 10 minutes. Yes, let's just finish, because I can see we have 7 minutes which are remaining. So let's finish. Let's finish. I want us now, we proceed, prepare the statement of financial position. Let's finish. Let's finish. Let's finish. So we go to part B. I think it's only one item which will be involving, because most of the items we have computed them. It's just a matter of posting them. So part B, the statement of a financial position. So this is as at 31st of March 2021. So remember, we prepare this one based on the accounting equation. We always start by recording assets, which we classify into two, non-current and current. Also here we need to have a single column, and basically the figures are in thousands of shillings. So what do we start with? We start by recording the non-current assets. The non-current assets. Now, for the non-current assets, I hope you can remember you have two. Which non-current asset? Can you remember the two non-current assets we have? Yes, we have property, which comprises of land and buildings, and also we have a plant and equipment. Is that the case? We have two. Now, in preparing a statement of financial position for publication purpose, all tangible non-current assets, because those are two tangible non-current assets, we don't record them here separately, but rather what we do, we compute their net book value at the end of the year, and we record a single figure here under the name of the property, plant, and equipment. So property, plant, and equipment basically comprises of all tangible non-current assets. So therefore, those tangible non-current assets, we don't record them here separately. If you record them separately, in these questions, you lose the math. You have to compute the total net book value of all tangible and current assets. You record them here as a single item called the property, plant, and equipment. So basically, I've said these include all tangible and current assets. I will start with the land and buildings. So buildings, or let me start with land. So maybe up there we can say this land. So basically, we know land was revalued at an amount of 160. So is land being depreciated? No. The value for land remains the same at the end of the year. So then to this, we add buildings. Buildings was revalued. Remember, anytime an asset has been revalued, you ignore the previous values of the asset, the previous cost, the previous accumulated depreciation. Now you work with the new value. The new value for the building is this one, 485. But now we know this was the value at the start. Was the value at the start. If it was the value at the start, and there was a depreciation of this amount, So what will be the net book value for buildings at the end? It will be equal to the revalued amount at the start minus the depreciation for the current year only. We have to ignore the previous depreciations. So the depreciation given in the trial balance, we ignore it anytime an asset is revalued. Sasa, yes. This is the new value. Then you only less depreciation for the current year. That is for buildings. And then to this, which other tangible and current asset do we have? It is plant and equipment. Plant and equipment, we will take the cost given in the trial balance, which is 427,000. Then to this, what do? We less the accumulated depreciation at the start, which is within the trial balance. The accumulated depreciation at the start for plant and equipment is 85,400. And then to this, we also less the depreciation for the current year, which is 51,240. That is basically how we compute the net book value of an asset at the end. The cost at the start minus accumulated depreciation at the start minus the depreciation for the current year. So whatever you get here will be the net book value for all tangible and current assets. Can you give me the final figure here? So we start with the buildings. So we have 485 minus 19.4 plus 427 minus 85.4 minus 51.24 plus 160. Is that figure correct? Is that figure correct? I doubt it. I doubt Morimo's figure here. $915, $960. Yes, $915, $960. So then from there, we check whether we have any other non-current asset. The other non-current asset you may include here, include investment property, which we don't have, include investment, which we don't have. So meaning we need to proceed and we record the current asset. The current assets, we have a number of them. So in the trial balance, all assets have a debit balance. So below plant and equipment down there, I can see we have the inventory at the end of the year. The inventory which we record here is the closing. How much is that? 324,500. Below that, I can also see we have the trade receivables. Which is 469,700. And then down there, what we have are expenses. It basically means that in our case, we don't have any other item of current asset. So what we do is we proceed and we get the total assets. The total assets, we take the non-current asset plus current. And I'm getting 2160. Is this correct? 2160. Huh? Yes. Okay, I'm given by Helen 1710. Okay, yes. My figure is automatically long. So this one will give us 1710. 160. So then from there we proceed and record now the items of equity. So for items of equity, that one we have those figures here. So it's just a matter of transferring them to our statement of financial position, equity. So what we record at the equity is the share capital and reserves. So we record this. So we have ordinary share capital. Ordinary share capital, this one is 672,000. Then we have the share premium. Share premium, this one, 48,000. So below that, we have the retained earnings. The retained earnings. The retained earnings, the balance at the end is 450, 800, and then we have the revaluation reserve. The revaluation reserve, and basically the revaluation reserve is how much? 35,000. So that will give us now the total equity. The total equity is this one, which is 12,05,800. 12,800. Sorry, that is 12,05,800. And I think in our case, we are done with equity. So we need to wind up by recording now the liabilities. By recording the liabilities. So for the liabilities, we classify them into two: the non-current liabilities and current liabilities. Now, for a company, the non-current liabilities may take the form of a bank loan or debentures. So if you check on this particular question here, we don't have debentures, we don't have bank loan. So meaning that this company didn't have any non-current liability. Okay, there is something we need to include here, because other than bank loan or debentures, this company had a deferred tax. Remember this deferred tax. This deferred tax is basically a tax to be paid by the company in the future. A deferred tax, that one is recognized here as a non-current liability. And basically what we bring here is the deferred tax at the end. This one, 87,600. Yes. So then finally, we record the current liabilities. We record the current liabilities. Current liabilities, these are liabilities payable within 1 year. So liabilities in the trial balance, they have a credit balance. So we check the items on the credit side of the trial balance. Up there, I can see share capital, share premium, retained earnings. Those are items of equity. And then down there, I can see accumulated depreciations. Are those items of liabilities? No. Then down there, you can see we have bank overdraft. The bank overdraft, this is a current liability, and the bank overdraft is 43,100. Then below that, I can see we have deferred tax, which you have dealt with. And then below that, we have trade payables. So the trade payables is an amount of 259,860. And then below that, we have current tax, which you have already dealt with. And then revenue, which is not a liability. So I think we are done with that. Maybe you can check here. Do we have any other current liability to be captured there? Yes, I think in this note, in relation to note number 3, we have the estimated tax liability. How much tax was our company supposed to pay during the current year? This one. The estimated tax liability the company was supposed to pay during the current year before adjusting that with over provision or other provision from the previous year. Our company was supposed to pay a tax of this. So that one, because it was not yet paid, and that is why it is part of the additional information, we also recognize it here as a liability, as a current liability. This tax will have to be paid within the next 1 year. And I think in our case, we are done. So what we need to do is we get the total equity and liabilities. The total equity and liabilities. So get the total equity and liabilities here. Get the total equity and liabilities. The total equity and liabilities. The total equity and liabilities. Total equity and liabilities. So you add all this, all that, it will give us a total of what I'm told by Zipporah, it will give us the same value, 17, 10, 1 what? 17, 10, 1, 60. 17, 10, 1, 60. Yes, I hope the rest are getting the same. That is, yes. Are you getting the same value? Are you getting the same value? Are you getting the same value? The same value, is that what you're getting? Yes. So that is confirmed. So basically that is it. That's what was required as far as that question is concerned. So, and remember you say that this is a very important topic because if you go through the past papers, you'll be able to see there is a question almost in each and every sitting coming from this topic. So maybe we stop for at that point for today. I'll give you an assignment. You attempt this particular question. We will see whether once we meet in our next class, whether we will be in a position to do at least 2 questions on this. At least 2 questions so that we wind up with this topic. I want you to attempt this question for August 2023, question number 5. You attempt this one. Once we meet in our next class, we will be able to see whether we can be able to do this one plus another question. That's yes, yes. So let's stop at that particular point. We continue from there in our next class, which will be on Saturday. So have a good night. See you on Saturday. concerned is how the listed companies prepare their financial statements at the end of the year. So, but maybe first of all, you can ask yourself, what are listed companies? Listed companies are basically those companies whose shares are trading in the securities exchange market. Like in Kenya, we have so many listed companies. We have a company like what? Safaricom is a listed company. Kenya Commercial Bank is a listed company. Equity Bank is a listed company. All these companies, at the end of the year, they are required to prepare financial statements, which will be published. Published means that once those financial statements have been prepared, they will be made available to the shareholders, including the members of the public. That's why we refer to those financial statements as the published. They will be made available to the members of the public. Now, when the listed companies are preparing their financial statements, which are then to be published, those financial statements should be prepared in accordance with this particular standard here, International Accounting Standard number 1. And therefore, in this case, we can say IAS 1 basically prescribes how the listed companies should prepare the financial statements for publication purpose. And therefore, this particular standard 1, it basically prescribes what a complete set of the published financial statements should contain. And number 2, how should those particular financial statements be prepared? Maybe first of all, we can look on what is contained or what should be contained in a complete set of the published financial statements. Remember, you have said published financial statements and financial statements to be prepared by listed company for publication. Now we are saying a complete set, set of the published financial statement should comprise of the following component. The following component, 5 components. Number 1, we have the statement of a profit or loss. Number 2, we have the statement of a financial position, formerly known as the balance sheet. Number 3, we have the statement of changes in equity. The statement of changes in equity. Number 4, we have the statement of cash flows. Statement of cash flows, of which this statement of cash flows, this one we're going to do this as a separate topic. And basically in this case, we will be able to see that a statement of cash flows is prepared in accordance with a different standard, which is International Accounting Standard number 7. Then number 5, we have the notes to the financial statement, the notes to the financial statement. So therefore, a complete set of the financial statement prepared by a listed company or by a listed company for publication purpose, basically we are saying should comprise of these 5 components. So I've said in this topic, we're going to look on how we prepare, we're going to look on 4 components. One, we're going to look on how we prepare, what is a statement of profit or loss, how do we prepare the same, a statement of financial position, how we prepare the same, a statement of changes in equity. This one we will do it as a separate topic, and also we will discuss something to do with what? To do with the note to the financial to do with the note to the financial statement. But basically, I want us maybe we start by discussing on what are the notes. What are the notes to the financial statement? Now, the notes to the financial statement, we can say that these are the supplementary notes. Supplementary notes, these are the notes which accompany the financial statements. Once a company has prepared the financial statement, those financial statements can be accompanied with some notes. So the main objective of those particular notes basically is to provide more information about some of the figures which are contained in those financial statements, and maybe also to provide certain information to the shareholders which is not captured in those financial statements. So therefore, these notes to the financial statement, we can say that these are supplementary notes. These are supplementary notes. Supplementary notes to what? To the financial statement. They basically supplement they supplement the information which is contained here. They supplement the information which is contained here. They provide more information other than the information which is provided in this word, financial statement. So these notes basically contain information about what? Contain information about the accounting concepts, the accounting concepts, which were used, the accounting concept used in preparation of the financial statements, and also the accounting policies used by the company, not used rather, the accounting policies adopted by the company to be able to prepare the financial statement. So basically what we know is that when a company is preparing the financial statements are prepared using various accounting concepts. Good examples of the accounting concepts used in preparation of financial statement include something like the accrual concept, the prudence concept, the going concern concept, and so on. So therefore, in this particular note, the company will be providing information about the accounting concept which we were relied upon in preparation of those financial statements. Number two, the company will also provide information about the accounting policies adopted in what? In preparation of this financial statement. When we talk about the accounting policies, we are talking of, for example, how the company is depreciating the asset. Is the company depreciating the asset using straight line or basically using the reducing balance method? So that information will be provided in this particular. That information will be provided in this particular notes. And also here, the company can also provide information about how the inventory was valued, because the company should determine the value of the inventory at the end of each year. So for those who are doing management accounting, for those who have done management accounting, you know, to determine the value of the company's closing inventory, there are various methods which can be used. We have RIFO, we have FIFO, and also we have the weighted average method. Now, in financial reporting, inventory should be valued using two methods, using weighted average method or RIFO. So the company in the notes will clearly explain which method was used to determine the value of the closing inventory. Is it weighted average method? Is it RIFO? So some of the information, therefore, which may be contained in these notes will include what? The basis of presentation, the basis of presentation of financial statement. So basically, in these notes, the company can provide information that the financial statements were prepared in accordance with the International Accounting Standard number 1 and also in accordance with the Companies Act. So that is the basis of preparing the financial statement. So also here, the company will provide information about depreciation of assets. How was the asset depreciated? Were they depreciated using straight line or the reducing balance method? The company may also include information about what? About contingent assets. Contingent asset, this refers to the probable assets or the asset which may or may not arise in the future, which may or may not arise in what? In the future. There is a topic we will be able to discuss more about this. I think at the IS, in the topic number 1, there is something we are going to discuss about this. So in the notes may also include information about the contingent liabilities. Contingent liabilities are probable liabilities. Liabilities which may or may not arise in what? In the future. So therefore, these are some of the items which may be included in these particular notes, which accompany the financial statements which have been prepared. Then let's come back to this one. Remember, I've said in this topic, we will not discuss this one. This one, we will do it as a separate topic. So then from there, what is a statement of a profit or loss? A statement of profit or loss, this one can also be known as the income statement. It can also be known as the statement of comprehensive incomes, statement of comprehensive income. So this one basically is prepared by a company to determine the financial performance of a company in a certain year. Meaning that A statement of profit or loss basically will be prepared to compare the incomes with the expenses. The difference between the incomes and expenses is automatically the profit for that year. Now, how do we prepare this income statement in accordance with the International Accounting Standard number 1? Or is there any difference in terms of how we prepare an income statement for publication purpose and how generally the income statement is prepared? Yes, there is a difference. When preparing an income statement for publication purpose here, in accordance with IAS 1, all the expenses of the company, are basically classified under 5 categories. If you can be able to recall, for example, in financial accounting, in that unit of financial accounting you looked on how companies prepare their financial statement, and you are preparing expenses separately. Salaries, depreciation, rent, you are recording those expenses separately. But in this case, we are saying, in the preparation of this statement of profit or loss for publication purpose, we classify the expenses into how many categories? Into 5. The first category is something called the cost of sales. A cost of sales. So this cost of sales, the cost of sales is basically, or how do we compute the cost of sales? How do we compute this cost of sales? I hope you can be able to recall in the lower level, you are computing the cost of sales by taking what? By taking the opening inventory plus purchases minus the closing inventory. Is that what we do here? No. So in this case, we compute the cost of sales by taking the opening inventory of the company plus purchases minus the closing inventory. But in this case, we go further and include depreciation. Depreciation on PPE. Depreciation on PPE should be included here unless told otherwise. There are some instances whereby you can be told the depreciation on PPE, classify that as part of distribution or part of the administrative expenses. But if the question is silent, include that here. And then to this, we also include the loss on disposal. Loss on disposal, this whereby the company sold assets during the current year, but at a loss. So that is an expense, we add it here. But in case the company sold some asset at a gain or at a profit, so the gain basically we know is an income. So what we do is that that gain, we deduct it here because it's an income. So remember, cost of sales is an expense. So this gain should reduce the cost of sales because the gain is an income. So that's how we compute the cost of sales. The other category of expense is the administrative expenses. So these are expenses incurred by the company, or these are expenses which are incurred as a result of managing or running the affairs of the company. These are like the office-related expenses. And the expenses which are incurred as a result of managing the affairs of the company. They include things like the office rent, the office salaries, and so on. Then from there we have the distribution cost. Distribution cost, basically, this is a cost which is incurred by the company in selling goods and distributing goods to customers, like the advertising costs, the carriage outwards. So the transport costs incurred by the company in delivering the goods to the customer's premises. All those are distribution costs. And then from there, we have the finance cost. Finance costs, these are costs incurred by the company in leasing finances. So these include things like the interest on loans, the interest on debentures, things like the preference, or actually the dividends on redeemable preference shares. This is basically very important. You must be able to remember this. In case you come across a question and you're told the preference shares issued by the company are redeemable. So redeemable preference shares are preference shares which have been reissued by the company, and the company has an obligation to redeem, to buy them back after a given period of time. So this is just like a loan. We know a company borrow a loan, the company agrees with the bank, the loan has to be repaid back within a certain number of years. The same case, these shares are issued, the company agrees with the holders that they will be bought back they will be redeemed by the company after a number of years. So this is a non-current liability to the company in the balance sheet or in the statement of financial position, and the dividend on these shares is classified as part of the finance cost. And then from there we have the other expenses. So the other expenses basically refers to any other expense incurred by the company, but does not qualify to be classified under the above four what? Under the above four categories. So therefore, in preparation of this statement of profit or loss, or basically an income statement or a statement of comprehensive income, we basically classify the expenses into what? Into 5. Then, also when preparing this statement of profit or loss for publication purpose, we only have a single column. Maybe in the lower level, you used to have like 2 columns here. In this case, we only have 1 column. And how do we prepare this? We start with the sales, but in most of these, at this level, you'll not be given the sales, but you'll be given something called the revenue. You'll not be given the sales, you'll be given the revenues. So and then to this, we less the cost of sales. Cost of sales, now you have to recall, how do we compute this? This is basically the computation of the cost of sales. You compute that, here you bring the final figure. The final figure, and then we get the gross profit. The gross profit. So to this gross profit, we proceed and we add other incomes. So the other incomes of the company may include what? The other incomes of the company may include investment income, and basically this investment income should be deducted from that. Sorry, not deducted. Sorry for that. Should be added, not deducted. This is an income, not expense. Okay, so then this may also include things like what? Things like revaluation gain on investment property, and the things like the revaluation gain on financial assets at fair value through profit and loss. This is basically something we came across in the topic of financial instrument. In the topic of financial instrument, so those are basically some of the other incomes by a company, So basically after that, we proceed now and we less the other expenses. Remember, here we have already captured one expense. So the other expenses, maybe you can just get the total incomes. We less now the expenses, which include the administrative expenses, the distribution cost, then the finance cost, and basically any other expense. And then we have the profit before tax. Now, to this profit before tax, we proceed and we less the income tax expense, And if you can be able to recall from our previous topic, this income tax expense basically comprises of 2 components of taxes. I hope you can be able to remember specifically what we did on Tuesday. This comprises of the current tax expense, which should be deducted from the figure up there, from this figure. And this one also comprises of the deferred tax expense stroke deferred tax income. So if we have a deferred tax expense, that one should be deducted from this profit. If we have a deferred tax income, that one should be added. And then what do we get? We get now the profit after tax. We get profit after tax. So the profit after tax, this one can also be known as the net income. It can also be known as the profit for the year. This is something you have to recall from what we did in the topic of ratios. We said profit after tax is the same with the net income, is the same with the profit for the year. And then out to this, we proceed and we add something known as the other comprehensive income. This is basically something I've explained in so many topics. I've explained what is the difference between other comprehensive incomes and other incomes. I said other incomes, these are incomes which should be part of the profit for the year. They should be part of this profit. They include all this. Other comprehensive incomes are those incomes by the company. They should not be included within the profit for the year. Now, what are good examples of these other comprehensive income? These include any revaluation gain on property, plant, and equipment, any revaluation gain on financial assets at fair value through other comprehensive incomes. Through other comprehensive income. Remember also this something we came across in the topic of financial instrument. Then from there, we basically proceed and we get the total comprehensive incomes. So this is how we prepare statement of profit or loss, which we are also referring to as the income statement, also known as the statement. We have a difference in terms of how we are preparing this and how we used to do in financial accounting. Yes, you can see there is a difference because here you can see expenses majorly are classified into 5 categories. In other terms, we say that this statement of profit or loss, we prepare it in a condensed manner. We try to condense items. So we try to not to record most of the items of expenses and also incomes separately. We classify them under specific headings. So having this, then I want us to move and look on the is it the third? It should be the third one, because first of all, we have discussed on the notes. This one should be the second. So then from there, we have the statement of financial position. And no need to worry, I'll be able to share the notes on this. I'll be able to share the notes on this. So no need to worry. But we said whenever you're discussing this in class, maybe you can just be sketching something. Maybe for your understanding, but I'll be able to share the notes on this. Now, a statement of financial position, formerly known as the balance sheet. This is something we have come across in so many topics. In the topic of cooperative society, in the topic of financial statement of professional firms, financial statement of those entities involved in farming or agriculture activities. This is basically something you have come across in so many topics. Now, this one we know is prepared to ascertain the financial position of the company, financial position of a company at year end, or basically at the end of what? Of the year. At the end of the year. At the end of what? Of the year. At the end of the year. At the end of the year. At the end of the year. Is Morimu clear? Is Morimu clear from your side? Is Morimu clear from your side? Is Morimu's video clear from your side? Is Morimu clear from your side? Yes, Francis, check the internet from your side. Check the internet from your side. Okay. Statement of financial position. It is prepared to ascertain the financial position of a company at the end of the year. At the end of the year. Now, this one, basically, we know is prepared based on the accounting equation. The accounting equation states that assets are basically equal to equity. In case of a company, we talk of equity, not capital, plus what? Plus liabilities. Plus liabilities. Is there any difference? Is there any difference in terms of how we prepare this statement of financial position of a listed company and how we prepare the other statement of financial position? No much difference. No much difference. So in here, we start by basically recording assets. And what we know is that the asset must be classified into 2, non-current assets and current assets. We get the total. We proceed and record equity. Equity, we know this comprises of ordinary share capital plus reserves. And then from there, we record liabilities, which include non-current liabilities and current liabilities. So not much difference in terms of how we prepare this one. So in fact, we will not be discussing on the format, because the format which is used here is what we have been doing in all other topics, So then from there, next, I want us to look on the last component. So I want us equally we do a question today. So number 4, we have a statement of changes in equity. Statement of changes in equity. In other terms, this can also be known as the statement of changes in net assets. Statement of changes in net assets. First of all, we can ask ourselves what is equity. So basically equity, this one is the share capital and reserves. Share capital and what? And reserves. Equity comprises of share capital and reserves. And therefore, this one, that is equity, this one is basically prepared to do what? To explain the movement in the various items of equity. So why did the various items of equity change during the current year? If, for example, the share capital of the company, the share capital of the company at the start was maybe 10 million, and at the end of the year, the share capital of the company increased to 20 million. Why was that? Why did the share capital increase? So you can only be able to know the cause of that increase from this statement of changes in equity. That's why we are saying that this one is prepared to explain the movement, to explain why the various items of equity changed during the current year. So how do we prepare this statement of changes in equity? So to prepare this one, basically, we should have various columns. Here, the first column is always the details column. The details column, that is the first column. And then we include columns equal to the various items of equity the company is having. So some of the common items of equity a company may have comprises of ordinary share capital. Ordinary share capital, that is one of the item of equity. The other one is the share premium. Share premium. I know this something you know from financial accounting, specifically financial statement of a company. Yes, can you give me another item of equity? I see whether you can be able to remember. So some of the items of equity, share capital and reserves. We already have share capital. We have share premium, which is a reserve, which is the other item of equity which a company may have. Or the other item of equity, as I'm told by Helen, is the retained earnings. The retained earnings, also known as the retained profit. The other one is what? 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 You can't remember those items of equity. The other one is revaluation reserves. Revaluation reserves. Revaluation reserves. We may also have something like the general reserves and so on. So, but basically these are the common items of equity. Share premium, ordinary share capital, share premium, retained earnings, revaluation reserve, general reserve, and the total column there. So basically this should be the last column, the total column. So what do we start with here? We always start with the opening balances. The balance brought down. The balance brought down, this is basically the balance at the start of the year. So we record those balances here, those balances there, and then we get the total, we take it to the last column. And then from there, we have some adjustments for the transaction which occurred during the current year. But the first adjustment which we make here is something called the prior year adjustments. prior year adjustment. So when talk about the prior year adjustment, this is maybe an error which was committed in the previous year and which was supposed to affect the profit of the previous year, but that error was not corrected. So that error you come and you correct it to this opening or to this retained earnings at the start of the year. So that error, basically it always depends with the type of error. It can be either be added or basically be what? Deducted. For example, in this case, you may be told in the previous year, there was some bad debts which were written off, but they were not accounted for. So it basically means that those bad debts which were written off in the previous year, which were never accounted for, they were supposed to have been treated as an expense. And because they were not accounted for, this profit for the previous year was overstated. Because if an expense was not accounted for, the profit which was reported in that year was overstated. So you less it here. So then you take that to the last column. Okay. So this one should be dash like that. So then the other adjustment which we may capture here is basically issue of shares. Issue of shares. Maybe there are shares which were issued for cash. Mostly that will affect the ordinary share capital, the share premium. Another one is a right issue. A right issue, this where the issue issues shares to the existing shareholders of the company, but at a price below the market price. Equally, that affects the share capital and the share premium. We take that to the last column. The other transaction we may take into account here is a bonus issue. A bonus issue is basically where the company issues shares free of charge. Usually that this one increases the share capital. And then once the company has issued shares free of charge, it is for the company to pay for these shares. The company pay for these shares using one of the reserves. The reserve which may be used by the company include either the share premium or the retained earnings. You'll always be told if the company made a bonus issue, which reserve was used? Is it the share premium or is it the retained earnings? The company can either use one of those two. And basically what happened is that in case of a bonus issue, the share capital of the company increases, and then the reserve which was used to pay for those shares will reduce. That's why you can see we are deducting here. We are deducting the reserve which was used and then transferring it to the share capital. So then what else do we capture here is profit after tax. The profit after tax from the income statement, we take it to this column for retained earnings and then equal it to the total column. So the other item which we also capture here are the interim dividends. Interim dividends. So interim dividends, these are the dividends which were paid by the company in course of the year. So those dividends are always paid from the profit. That's why you can see we are raising that there. The other item which we may also have here is transfer to general reserves. Transfer to general reserves. You may be told the directors proposed to transfer a certain amount from the retained earnings to what? To general reserves there. To general reserves. And finally, the other item we may have here is a revaluation gain or a revaluation loss. In this case, you can be told some items of PPE were revalued upward or downward. So if there was a revaluation gain, we bring it in this column known as the revaluation reserve as a positive. If there was a revaluation loss, we still bring it here, but as a negative. And then we take that now to the last word, to the last column. Yes, so basically those are some of the items which we may capture here. And basically then from there we get what? We get the balances at the end of the year. The balances at the end of what? Of the year. So these balances at the end of the year, this one we transfer them to the statement of financial position. These ones are transferred to statement of financial position, specifically under equity. Specifically under what? Under equity. Under equity. So therefore, this is basically how we prepare the statement of changes in what? In net asset, or basically the statement of changes in what? in equity. In what? In equity. So basically that's what you need to know as far as the preparation of the public financial statements are concerned. Maybe something you need to remember, something else you need to remember. I'll be able to explain that in course of doing our question, in course of doing our question. Sasa, in course of doing our question. Now, I want us to take a small breather because I want us to come back and basically we look on a question. We must finish on a question today, but we will start with a question which is not that demanding. Basically, we start with a small question. So, and I want us to start with a question. I think we were able to. There is a question which we did part of it, December 2021. That is a question I want us to start with. That is a question I want us to start with after the break. And I think this was question number 5, if I'm not wrong. There is a question we did something to do with the deferred tax and the current tax. I think it was a question for Bawabu Limited. Was it for Bawabu? The question we tackled in our previous session in relation to was it deferred taxes? Deferred taxes. I think it should be that one. Should be that one. It should be that one. So let's take a short break or a small breather, basically, for 5 minutes. For 5 minutes, we come back. As we come back, make sure you have that question with you. That is a question I want us to do. I want us to do after the break. Sasa, yes. So see you after that short break of just 5 minutes. 5 minutes. Has been computed wrongly. So let's go to this question here for August of 2024. August of 2024. Specifically, that is the question number 4. Yes, and I hope you're there. I hope you're there. So what are we told? What are we told here? So the question is, the following financial statements were extracted from the books of 𝐅𝐎𝐂𝐔𝐒 Group. So we are given the consolidated statements of financial position as at 31st of December 2022 and 2023. We have the non-current assets, which include PP, goodwill, other intangible assets, and investment in associates. We are given current assets, which include inventory, accounts receivable, cash, and cash equivalents. And then we have the equity, which comprises of ordinary share capital, revaluation, surplus, retained earnings. And then we have the non-controlling interest. We have long-term or the non-current liabilities, which include long-term loan, deferred tax, the current liabilities, which include account payable and current tax. Then we have the consolidated statement of profit or loss. We are given additional information number 1, 2, 3, 4, 5. What are we required to do? We are required to prepare the statement of cash flows for 𝐼𝐶 Group for the year which ended 31st of December 2023 using the indirect method. and also in accordance with IS what? 7. So basically, once you come across this particular question in an exam, never use the approach which you have used in the other question. You do the workings because remember you don't have all the time with you. So such a question you must complete it within what? 40 minutes. So how should you approach such a question? How should you do this particular question in an exam? So we always advise the student always start with the title. So the title here will be 𝐎𝐍𝐋𝐈𝐍𝐄 group. This is the consolidated statement of cash flows. Consolidated statement of cash flows, basically which is for the year which ended 31st of December 2023. 31st of December 2023. Then after having that title, you also need to remember that we need to compute cash flows from how many activities? Cash flows from 3 activities. The cash flow from operating activities, the cash flow from what? Investing activities, and finally cash flow from the financing activities. So have those subheadings. You have those subheadings, and remember here, we always start by computing the cash flow from operating activities. Operating activities, we need to have 2 columns here, and our figures are in million of shillings and in million of shillings. Because basically by doing this, there are so many free marks you should be able to get. And remember, I've said that most of these particular questions for cash flow, for any correct entry which you have here, you are given 2 marks. So like you can see, this is a question for 20 marks. It basically means that you need to get 10 items correct. For each item you get correct, you get how many marks? You get 2. By the end of the day, you have 20. So therefore, this question, even if you don't compute all the items, you just record the obvious items, the obvious entries, is a question you should be able to get almost all the marks, almost all of the marks. So once you have this, leave enough space here because we have so many items which are recorded here. Then you have the other subheading for computing the cash flow from investing activities. We don't have so many items which we record here. And then from there we proceed, and we have the other subheading for computing the cash flow from the financing activities. Equally, remember we say that all the items which we record here, we get them from equity, non-current liability section. And then down here, come and record the cash and cash equivalent, balance brought down, the cash and cash equivalent, balance carried what? Balance carried down. And in this case, I always advise the student, can you start by recording these 2 items? Because these are just for 3 marks. So cash and cash equivalent at the start and also at the end. So in most of the questions for cash flow, the examiner will have given you this, cash and cash equivalent at the start and also at the end. But if you're not given this, you have to record, we say that cash comprises of the cash in hand, the cash in hand. It also comprises of the cash at bank, it also comprises of a bank overdraft. But in this case, a bank overdraft, you take it as a negative. You take it as what? As a negative. And also in this case, we say at the current asset, check whether you're given short-term investment. Short-term investment or something called the financial asset at fair value through profit and loss. So in case you're not given cash and cash equivalent, at the start and also at the end, these are the items which you use in computing this. But if you check on this particular question here, are we given the cash and cash equivalent at the start and also at the end? You go to where we have the current asset. Where we have the current asset in the consolidated statement of financial position. Do we have the cash and cash equivalent at the start and also at the end? Yes. So those are basically 3 marks. So they call the cash and cash equivalent at the start. And I hope you can see in our consolidated statement of financial position, we are given the consolidated statement or financial position for 2022, 2023. It's important for you to note that these values we have here are opening balances. These are the closing balances. Sasa, yes, you have to be very, very keen there. So the opening balance are the values we have here in 2022, and the cash and cash equivalent at the start was 340. The cash and cash equivalent at the end is what? Is 450. So if, for example, this is how the question is marked, so basically you already have 4 marks there. You already have 4 marks. If for every correct entry you record here is 2 marks, you already have what? 4 marks. And then from there you come back here. Here, remember we said we start with what? Under the indirect method, we start with the profit before tax. So the profit before tax, this one we get it from the consolidated statement of profit or loss. Can we go to the consolidated statement of profit or loss? We take the profit before tax. Profit before tax, how much is that? You can be able to see that figure for the profit before tax. Profit before tax, I can see that as a figure of what? Of 380. I can see that as a figure of 380. And then basically to this, we make a number of adjustments. We make a number of adjustments. So the first adjustment we said is to add back the finance cost. That's what we said. So we add back the finance cost such that by the end of the day, we will have the profit before interest and tax. And the finance cost is just above that, which is basically a figure of 140. So I add it there such that we have now the profit before interest and tax. And now, even before we go to the additional information, there are some other items which we also adjust to this profit. Like above this profit before tax, I can see the share of profit of associate. We say this is a non-cash item. Because it is added in arriving at that, we less it. The share of a profit of who? Of associate. Which is how much? Which is 180. So take into account it is added here. It is basically a non-cash item. We do what? We less it. And then in this case, above that we have finance cost, we have operating profit, administrative distribution. Those are operating expenses. Yes. So we said maybe the other item which you may check, like the other question which we did yesterday, we were given the gain on disposal of the subsidiary, which we said, in case you have that, let's start from here. Yes. So those are obvious entries. Those are obvious items which you can be able to record here without any working. Without any what? Working. Then from there, we go to the additional information. We basically record what we can be able to record directly here without a lot of work, a lot of working. So let's go to note number 1. In note number 1, you're told during the year, which ended 31st of December 2023, that is the current year, 𝐅𝐎𝐂 Group acquired 60% of the ordinary shares of 𝐒𝐻𝐄 Limited for a cash consideration of 720. So we have a subsidiary which is acquired. A subsidiary acquired, remember, we said is an investing activity. So come here and you say there was a subsidiary which was acquired. So we said for the subsidiary which is acquired, we consider the net cash outflow. The net cash outflow, we take the cash which was paid, which basically is 720, and that is a cash outflow. And then to this, we less the cash balance, which this subsidiary was having. So how much is the cash balance? This subsidiary which was acquired, in note number 1, paragraph 2, we are told the fair value of the identifiable net asset of 𝐒𝐻𝐄, the subsidiary acquired, were as follows. So that subsidiary which was acquired had PP, inventory, receivable, cash, payable, current tax. So this subsidiary which was acquired was having a cash of 80. So basically the parent company paid 720 and it acquired a subsidiary which had a cash balance of 80. So what is the net cash outflow? The net cash outflow should be the difference here. The net cash outflow will be negative 640. That's basically what we record there. So from there, let's move to the other point, and we are told 𝐅𝐎𝐂 Group measures non-controlling interest at the fair value at the date of acquisition. LCA is measured at fair value. And then you're told the fair value of the non-controlling interest in 𝐒𝐻𝐄 at the date of acquisition was 22. So basically that can help us in terms of computing the goodwill on acquisition of this subsidiary. But is that supposed to be recorded here? No, we can first of all ignore that. And then note number 2, we are told the group property, plant and equipment comprised of the following. So in this case, we are given a breakdown of how the value for PP at the start and also at the end was arrived at. So this is like the working we did yesterday, basically to compute the PP which were acquired. So, and I hope you can see we have the value of 34. That is the value for PP at the start. And down here we have the carrying amount at the end, 4570. So if you go to the consolidated statement of financial position, you should be able to see those values. The PP at the start, 34, the PP at the end, 4570. Are those the values we have in the consolidated statement of financial position? Yes, 34 and 4570. So what do we capture in our cash flow? So what we capture here, one, are the additions. The additions at cost, including asset of PP which were acquired. So what we are going to consider here are the PP which were acquired. The PP which were acquired in cash. The PP which were acquired in cash, we will take the additions. I hope you can see the additions, but you're told those additions automatically are PP which were acquired. They include the PP of the subsidiary acquired. The subsidiary acquired, remember, not one. So what we will do here, we will only consider the PP which were acquired in cash. So this includes the PP acquired in cash, and this also includes the PP of the subsidiary acquired. So we have to exclude the PP of the subsidiary acquired. The PP of the subsidiary acquired as per note number 1 is 280. So the difference basically represents the PP which were acquired in cash. The PP which were acquired in cash after eliminating the PP of the subsidiary acquired. So that will give us what? That will give us 1360. So that is the PP, those are the PP which were acquired in what? In cash. Still in note number 2, we are given the gain on property revaluation. Do we consider that within our cash flow? No. Revaluation gain on PP is a non-cash item. We don't consider that here. Then from there we have disposal. Disposal automatically, that one should be the net book value. So that is the net book value of the PP which were disposed. Basically, what we consider here in respect to the disposal of PP, if you can be able to recall, we said we consider the proceeds. Are we given the proceeds there? No, but we must be given that somewhere down there. So we don't consider the carrying amount, we consider the proceeds. And then from there also remember, in case there was an item of PP which was acquired, we will have to compute the gain or loss on disposal, which we adjust to our profit. So we said anytime you come across a transaction regarding the disposal of asset, 2 entries here, the gain or loss on disposal and the sales proceeds here. So then down here we have depreciation. Depreciation, remember, is one of the items which we consider here because these are non-cash items. The depreciation on what? On PP. The depreciation on PP, that one is an amount of how much? 210. Because this one was deducted in arriving at that profit and is a non-cash item, we do what? We add it back. We are done with that. And then in the last paragraph of note 2, we are told the disposal proceeds of the property, plant and equipment amounted to 540. So this item of PP which was disposed, it was disposed at 540. That is the sales proceeds, and that is a cash inflow. And then you are told in the same paragraph, and the gain on disposal has been netted off against the administrative expenses. So there was a gain. So what we need to do is to compute the gain on disposal, which has already been adjusted in this profit. We do what? We less it, the gain on disposal. The gain on disposal will automatically be equal to the profit, the sales profit. I hope you can remember the formula which I gave you, the sales profit minus the net book value or the carrying amount. The net book value of the asset which was disposed in note number 2, I hope you can remember, we are given the carrying amount of the item which was disposed. How much is that? This item which was disposed, its carrying amount is how much? Is it the one which is 330? In that working, for that working which we have in note number 2, yes, it is 330. So this item of PP which was disposed, it was disposed at a gain of 210. Is it 210? 210. So this gain In arriving at this profit, it has been added, but basically that is a non-cash what item. What do? Basically we less it. It's a non-cash item. So we, okay, in the last sentence of note number 2, we are told it is the group policy to make inter-reserve transfer of excess depreciation upon the revaluation of assets. So now, anytime you come across that there is inter-reserve transfer, that will affect the retained earnings. That will affect the retained what? Earnings. And once you're given that, always the examiner will give you the dividends which were paid by the parent. Because the dividends which were paid by the parent, we can't compute that using the approach which I gave you yesterday, because there was an amount of excess depreciation which was transferred to that account. So we will see whether we're given the dividends which were paid by the parent. In note number 3, we are told during the year which ended 31st of December 2023, 𝐅𝐎𝐂𝐔𝐒 Group acquired 30% interest in an associate for a cash consideration. For a cash what? Consideration. So basically, anytime as the parent company acquire an associate, that is also an investing activity. That is also an investing what? Is also an investing activity. Is also an investing activity. So here you consider 2 items as far as the associate is concerned. One, the associate which was acquired, you determine how much cash was paid. But I hope you can see in that case we are not given the consideration. We will compute that. Then also in respect to this associate, we said we compute the dividends which were received from the associate. So let's see what we are told. We are told the associate reported a profit of 600 and paid dividends of 200 out of that profit. So the associate which was acquired paid dividends of how much? 200. So in this case, what we're interested with are the dividends which the parent company received from that associate. The associate paid dividends of 200. How much dividends were received by the parent company here? Take into account the parent company acquired 30% shareholding. So the parent company acquired an associate. This associate paid dividends of 200 million. So remember the parent company acquired 30% shareholding here. So out of this, the dividends which were paid to the parent were 30%. 30% of these 200. So that will give us what? That will give us 60. So 30% of this. These dividends were paid to the parent, which will be a cash inflow, which is a cash inflow. That is basically what we consider here. What we consider there. Now, before we move to point number 4, I think also we can compute this. Can we compute this amount which was paid in acquiring that associate? And remember, you said, or how do we compute this one? How do we compute this one? Which approach are we going to use here? We are going to use the approach of computing the investment in associate. I hope you can be able to recall how we compute the investment in associate. But remember, in this case, I've said, if, for example, whenever you're doing this question, you feel a working is a little bit demanding, you can just ignore it, because you can see this question, even without a lot of working, the kind of entries we have. If you feel a working is a little bit complex, just leave it. It's not a must you get everything correct. But in this case, how do we compute the investment in associate? I hope you can be able to remember this. We said we take the cost of investment. The cost of investment is now what we are not given here. The purchase consideration, the cost of investment. The cost of investment. And then to this, we said we add the group share. The group share of what? Of associate post acquisition retained earnings. And then to this, we also less what? Any impairment loss. I think in our case, we don't have any impairment loss. We are not told the investment in associate had impaired. So basically what I want us to do here is we take the profit which was reported by the associate in note number 3. We are told the associate reported a profit of 600 million and paid 200 million out of the profit. Paid 200 million out of the profit. Paid 200 million out of the profit. So what do we consider here? We consider the retained earnings. The retained earnings of that associate will basically be the profit after the profit for the year minus dividend. So which is 600 minus the dividend. So that will give us the retained earnings of that associate. And then we get the group share of this. The group share of this should be what? Should be 30%. It should be 30%. Should be 30%. So this one will give us 120. Remember, you don't have any impairment loss. So we will get the investment in associate at the end. We are given the investment in associate at the end of the year. If we go to the consolidated statement of financial position at the non-current asset. At the non-current asset, can you see the investment in associate at the end? Is what? Is 770. Can you see that? 770. So the purchase consideration which was paid will automatically be the difference between these two values. The difference between those values. Is it coming to 550? How many 650? 650. Yes, 650. But in this case, remember I've said, if you feel our working is a little bit complex, unayat. Sasa, si lazima ucompute kila kitu. It's not a must, you have to compute everything. So let's move now to the other point. And you're told number 4, an impairment review carried out at the end of the year revealed that the goodwill and other intangible assets were impaired. So basically what that means is that here we will have the impairment loss on goodwill, impairment loss on goodwill, and also we are going to have amortization forward for intangible assets. For intangible what? Assets. I think we can start with this one. Because for goodwill, we have to compute the goodwill for the subsidiary which was acquired. So intangible assets, we have this as one of the non-current assets. And the non-current assets, can you go to where we have non-current assets? I hope you can see PP, have dealt with that. We have goodwill, we will come back to that. And then we have other intangible assets. Other intangible assets, the value at the start was 1630, and then that reduced to 1440. So basically there are two reasons why the value for intangible assets can reduce, either due to disposal or due to amortization. And if you check on the information which are given in the additional information, there is nowhere we are told in the intangible assets were disposed. Were disposed. So basically what that means is that decrease in the value for intangible assets is due to amortization. So how much is the amortization that decrease? From 1630 to 1440. That is a decrease of 180. And amortization taking into account, it was deducted in arriving at that. We do what? We add it back. Then for impairment loss on goodwill, we must prepare the goodwill account. Though that this one will not be, this one is not complex because I think we only have a subsidiary which was acquired. So we just need to compute its goodwill. So we said here we take the value for the goodwill at the start, and then the value for the goodwill at the end. In case there was a subsidiary which was disposed, you less its goodwill. In our case, no subsidiary which was disposed, but we have a subsidiary which was acquired. We compute its goodwill, and basically we include it here. So to compute this goodwill is quite simple. We know there was a subsidiary which was acquired as per note number 1. And as per the information which we have in the last paragraph of note 1, we are going to compute the goodwill of that subsidiary using the full goodwill method because you're given the NCH fair value. We will compute that goodwill using the full goodwill method. So how do we compute the goodwill using the full goodwill method? Just like what we did in the other question, we will take the purchase consideration which was paid by the parent. That is in note number 1, the first paragraph. Rahisi Group acquired 60% of the ordinary share capital of 𝐒𝐿, paying 720. So to this we add the NCH fair value which is within the last paragraph of note 1. The NCI at fair value was 220. So that is the purchase consideration paid by the parent, purchase consideration paid by NCI, and then we less 100% of the net asset of that subsidiary. So that subsidiary net asset was 480. Or for what? 480. That will give us the goodwill of the subsidiary which was acquired. So this 940 minus 480. This will give us what? Is it 460? Yes, 460. So that is the goodwill of the subsidiary acquired. So then the balancing figure, which will be on this side, automatically that will be the impairment loss. That is basically what we want to compute. So can we record the value for goodwill at the start and also at the end? So from the statement of financial position at the non-current asset, goodwill at the start was 650. At the end, it was 1010. 1010. So I think we need to compute now the impairment loss. The impairment loss. So that will give us 10 what? That will give us 1110. 1110 minus 1010. That will give us what? That will give us 100. So that is basically the goodwill. The impairment loss on goodwill. Impairment loss on goodwill is 100. So take into account this, in arriving at this, it was deducted. We do what? We add it back. I think we are done with that. And then note number 5, we are told ignore deferred tax on acquisition. Yes, I think with that now, we can come down here and basically we consider the changes in working capital. Remember, you say these are also free marks. These are also free marks. Free marks. So the changes in working capital here, we consider 3 items: the receivables, inventory, and payables. Receivables, inventory, and payables. And in this case, we say for us to be able to determine whether we have inflow or outflow, we just need to apply this formula: opening balance minus closing, opening balance minus closing for these 2 items of current asset. For payable, which is an item of current liability, we apply that formula: closing minus opening. But we said in this particular question for group accounts, we must first of all compute the opening balances. How do we compute the opening balances? We take the opening balances which are given in the statement of financial position. We add the receivable, inventory, payable for subsidiary acquired, and then we less the receivable, inventory, payable for subsidiary acquired. Whatever you get is the opening balances, is regarded to be the opening balances. Compare that with the closing balances. But in this question, we only have a subsidiary which was acquired, which basically make it more simple. So we will have those 3 items: receivable, inventory, and what? Payable. We will start by having the opening balances, and basically we will add the receivable, inventory, payable for subsidiary acquired. We will get the opening balances. So let's first of all record the opening balances from the statement of financial position at the current asset. At the current asset, we're given inventory at the start, which was 1830. Receivable is 1750. What about payable at the current liabilities? Payable at the current liabilities was 21.70. Then to this, we add a receivable, inventory for subsidiary acquired. In note number 1, that subsidiary had inventory of 160, receivable of 110, and payables of what? Of 120. So we add this. We add this. So this will give us 1860. This will give us 1990. And this will give us 2290. 2290. I hope those are the figures you're getting. And remember, these figures now, they are regarded to be the opening balances. They are regarded to be the opening balances. We compare that with the closing balances. We compare that with the closing what? Balances. The closing balances, this one, we have them in the statement of financial position. So we start with what we have at the current assets. Under the current asset, we have inventory, which is 1490. Receivables is 1220. What about payables at the end? Payables at the end is 1420. I hope I've recorded the correct values. Inventory, yes. So basically what we need to do is we compare this. Remember, this is the opening, this what? Closing. You just need to apply those formula. This. You just need to apply this. So for receivables, I'll take opening minus closing. Opening 1860 minus what? 12. 1860 minus 1220. So I'm getting a positive figure, which is 640. You record it as a positive. And then the other one, I'm told, is 500. So this minus that, which will give us 500, which is positive. And then for this one, we take the closing minus opening. Closing minus opening. 1420 minus 2290. So which basically will give us what? 870, which is a negative. So those are basically 3 marks. Anytime you come across a question for cash flow, always these are 3 marks. Remember, I've said, if, for example, this question is marked like this, any correct item you are given 2 marks. It basically means that in that question, you just need to get 10 correct items. 10 correct items. So it basically means that if that question we decided to leave it at that point, we already have all the marks. If we decide to leave it at that point, we already have all the marks. All what? The marks. So therefore, that's why I'm insisting that you should be able to know where to get 3 marks, where to get 3 marks, where to get 3 marks. That is very, very important. Very, very important. Once, maybe just to confirm how this, but if you check like that question which we did, that's how it was marked. For every correct item, the marks allocated there were 2. And maybe you can see this, how this one was being marked. How it was marked, because it's always good for you to know how do the examiners mark these papers. So like, let me see, let me just confirm. So this is a question number what? Question number 4. Question number 4. Yes. You can see this. This basically how the question was marked, like this. Any 10 correct entries, how many marks? How many marks? 2 marks. It basically means that that is a question within 40 minutes, you should be done. And basically you have all your 20 what? All your 20 marks. Because you can see like all these, most of the items here basically are 3 what? Are 3 marks. Sasa, yes, but basically let's record the other obvious items. Let's record the other obvious items. Down here, then we say we left 2 items, the tax paid, but tax paid, we said we have to prepare an account, and then the interest, which was paid. So for the interest, I don't think this one has any working. So for the interest of the finance cost paid, we said we just consider 2 items. We go to where we have current liabilities. We check whether we have any interest payable. Do we have any interest payable under the current liabilities? No. It basically means that the finance cost, which we have in the income statement, is basically the amount which was paid. Just record it here as a cash outflow. But now for tax, we said we must prepare an account. We must prepare an account. The tax account. So how do we prepare this account? We start by recording the deferred tax at the start, the current tax. For subsidiary acquired, was it having any tax liability? If any, record it on that side. So then we also record the income tax for the current year from the income statement. And then on this side, we record the closing balance for deferred tax, for current tax. We check, was there a subsidiary which was disposed? In our case, none. And then we get the balancing figure, which is the tax paid. So let's start by recording the opening balances for deferred tax, the current tax. And we get this from where we have current liabilities. So from where we have non-current liabilities, we have the deferred tax at the start, which is 820. The deferred tax at the end is 600. Then under the current liabilities, let's go to where we have current liabilities. Under the current liabilities, we have what? We have current tax. The current tax at the start, 780. The current tax at the end of the year is what? Is 420. Then we go to note number 1. Note number 1, the subsidiary which was acquired, was it having any tax liability? The subsidiary which was acquired, was it having any tax liability? Yes. It was having a tax liability of 30. It was having a tax liability of 30. We credited in that account. We still go to the income statement and we take the tax for the year. The income tax for the year, the income tax expense for the year. And I can see that is a figure of 150. A figure for 150. Yes. Do we have a subsidiary which was acquired? No. So we just need to get the balancing figure here, which is the tax which was paid. 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 Tax which was paid is how much? The tax which was paid, I'm told, is 760. 760? Yes, 760. So tax paid 760. Yes, I think we have done with that. Then here, I think major we have dealt with all items because I think almost everything here was given. So let's just go straight to financing. To financing, we said all the items which you record here, we get them from equity and current liabilities. Can we go to where we have equity? For equity, we start with the ordinary share capital. We can see the ordinary share capital increased. So the reason why share capital increases is because there was issue of what? Of ordinary shares, which is basically equal to the increase. And that is a cash inflow. Revaluation reserve, do we consider that here? No. And then rather revaluation reserve, we have the retained earnings. The retained earnings, this one, we use it in computing the dividends which were paid by the parent, but this one, no need, because there will be some adjustment in relation to note number 1. I think we can just ignore that. The dividends which were paid by the parent, let's just ignore that. Let's just ignore that, including the dividends paid by NCI. We can also ignore that. And then can we go to where you have non-current liabilities? We have long-term loan. Long-term loan basically has increased. So what we need to do, we need to check the subsidiary which was acquired. Was it having any bank loan? No. So that increase in long-term loan is as a result of acquisition of an additional loan. Acquisition of what? Of a loan, long-term loan, which is basically equal to the increase. How much is the increase there? In that loan forward? For 460. The increase in the value for the loan from 1530 to 1990. Yes. So that question relates like that. So if you do that question like that, that's basically a question you can see. You'll be able to do it within very few minutes. You have all the marks, and basically you're able to move to another question. Sasa is so I want us to look on a different question. Let's look on another question here. We also do it using the same approach. April 2022, let's go to that question. April 2022, the increase in bank loan was due to acquisition. How should we treat it? Okay, so basically what you do, in case, for example, the subsidiary which was acquired, the subsidiary which was acquired maybe had a bank loan, or basically had a long-term loan, of maybe something like 200 million. It basically means that this increase in bank loan over 600, so this is caused by the bank loan of the subsidiary which was acquired. So the subsidiary acquired, and then the difference to 60, this is the bank loan now which was acquired in cash. And what do you consider here now in your cash flow? What do you consider here is the bank loan which was acquired in cash. I hope you can be able to recall what we did in relation to the PP. Can you remember the PP which were acquired here? So we had a similar information. The increase in PP was 1640, but out of this, the PP of the subsidiary acquired were 280. So we only consider the PP acquired in cash. The same case with the bank loan. So if the bank loan increased with 460, the subsidiary acquired had a bank loan of 200. The bank loan now acquired in cash was, so the bank loan acquired in cash was 260. That is basically what we consider here. Sasa, yes, that's what we consider in our cash flow. That's what we consider in our cash flow. I want us to look on another question. We will also be able, we will do it using this approach. And I hope you can see even here in class, we are doing that question within a very short period of time. We are done. And basically, through that, you'll be able to create time to be able to handle the other questions. Because remember what we said is that for you to pass this paper, you must have, you must be able to know how to handle these questions. You may be very good, but doing this particular question in an exam, you need to have a strategy. You need to have a strategy how to handle those questions. I hope you are there in that question for April 2024. April 2024. Which is basically question 5. Question 5. But the beauty thing nowadays, they are not bringing complicated questions. The questions which are being tested nowadays, they are very, very simple. If you check on some questions which were tested some time back, you'll be able to see that they are very complex. But if you check on the questions tested nowadays, including the question for group accounts, they are very, very simple. They are very, very simple, very, very simple. Okay, so what are we told here? We are told the following draft financial statements related to Bustani Group. So we are given the consolidated statement of financial position. Under the non-current asset, we have PP, goodwill, interest in joint venture. So interest in joint venture is computed in the same way, just like the investment in associate. We have the total non-current asset. We have current assets which include inventory, trade receivable, cash and cash equivalent. Those are like now 4 marks. Even without going to prepare the cash flow, you should see some 3 marks there. Cash and cash equivalent at the start and also at the end. At the equity, we have ordinary share capital, share premium, revaluation, exchange loss, exchange reserve. I hope you can be able to recall when we were looking on the foreign subsidiary, I said once the parent company has acquired a foreign subsidiary, in cost of translating goodwill, profit for the year, and the net asset at the start, there is something called the exchange difference. That exchange difference, which is attributable to the parent, we said it is recognized as one of the components of equity. Automatically, once you see that, it means that the parent company here had acquired a foreign subsidiary. Had acquired a foreign what? Subsidiary. So we have that. And then we have the retained earnings, equity attributable to the owners of the group and controlling interest. And then we have the non-current liabilities, which include long-term loan, deferred tax. And then under the current liabilities, we have trade payables, current tax, and then the total. We have the additional information. We have okay, before we go to that, we are given the consolidated statement of profit or loss and other comprehensive income. And I hope you can also be able to see below and down there where we have the profit for the year, we have other comprehensive income. And basically, we are given the gain on revaluation. And then we also given loss on retranslation of the foreign subsidiary. I hope you can be able to remember, you say that any exchange gain or loss arising from translation of goodwill, arising from what? From translation of net asset at the start and the profit for the year, that one we said is recognized as part of OCI. So I hope you can be able to remember that. We are given additional information, number 1, all the way to note number 6. What are we required to do? We are required to prepare the consolidated statement of cash flows of Bustani Group, basically using the indirect method. So let's do that. So the name of this group is Bustani group. And basically this is the consolidated statement of cash flows, which is for the year which ended 31st of December 2023. I want us to do this question in the next 25 minutes. We should be done by basically recording the obvious items. The obvious items, those items which involve complex working, we just ignore them. We just ignore those items with complex workings. So we need to have the 3 subheadings. So here we start by computing the cash flows from operating activities. So our figures are given in million of shillings. We need to have 2 columns. 2 columns like that. Then leave enough space here. Then you have the other subheading for computing the cash flow from investing activities. And basically the other subheading, the last one, for getting cash flows from financing activities. And finally down here we have what? We have the cash and cash equivalents, balance brought down, and basically the cash and cash equivalents, balance carried what? Balance carried down. And basically in this case we have said always start by recording these 2 items, the cash and cash equivalent at the start and also at the end, because those are basically free months. So if you have that with you, that's skeleton. So we can basically proceed and record the obvious items. Yes, so let's record this. Let's start by recording the cash and cash equivalent at the start and at the end. So because I can see we are given that below or where we have the current assets in our consolidated statement of financial position. So the cash and cash equivalent at the start. And it's also important for you to see that in our statement for financial position, we are given the year 2023 and basically the year 2022. This is the closing balance. This is the opening balance. You have to be to see that, because you can see like the other question which you have done, the years were interchanged. Yes. So the opening balance are the values we have here, and these are the closing balance. So what is the cash and cash equivalent at the start? At the start, it is 880. At the end is what? Is 1060. 1060. Then we come back here. We start by recording what? The profit for the profit before tax. So the profit before tax, this one we get it from the income statement, the consolidated statement of profit or loss. Consolidated statement of profit or loss. I hope you can see that figure is basically an amount of what? Is an amount of 740. So we make a number of adjustments to this profit. We make a number of adjustments. So the first adjustment we make to that profit is basically to do what? To add back the finance cost. The finance cost is above that profit and is an amount of how much? Is an amount of 160. Add it back. So before we go to the additional information, we also have the share of profit, of joint venture. That is basically an non-cash item. The share of profit of joint venture. And because this one has been added to our profit up there, we need to do what? We need to less it. The amount of 240. The amount of 240. So what we will do in relation to that joint venture, we will compute how much dividends were received from the joint venture. The dividends received from the joint venture, that one is computed in the same way, just like how we compute the dividends received from associate. Sasa? Yes. So we have that. Those, I think, are the obvious items. Let's go to the additional information. Let's go to the additional information. In the additional information, number one, we are told, during the year which ended 31st of December 2023, Bustani Limited acquired 75% of 100 million ordinary shares for shillings 10 per value of 𝐻𝐒 Limited, 𝐅𝐎𝐂 subsidiary, 𝐅𝐎𝐂 what? Subsidiary. And then you're told the acquisition consideration consisted of cash of 880 and a share exchange of 2 shares in Bustani Limited for 3 shares, which were acquired in 𝐻𝐒. There was a share exchange consideration. Automatically, that one is not given. And then you're told the market value of Bustani Limited ordinary shares at the date of acquisition was 12. Now, in our case here, what we consider in preparing our statement of cash flows is the cash consideration. So when that subsidiary was acquired, so how much cash consideration was paid? The cash consideration which was paid, I hope you can see that in note number 1, sentence 2, it was 880. We don't consider the share exchange consideration. We consider the cash consideration. But automatically to this, because these are cash outflow, remember, is the cash outflow is a negative, we need also to consider the cash balance. That subsidiary which was acquired, was it having some cash balance? As per the information we have below paragraph 2, the subsidiary acquired, was it having some cash balance? Yes, it was having some cash and cash equivalent of how much? Who can see that? 70. So 70, that is a cash inflow. This is a cash outflow. So we have a net cash outflow of what? Of 810. Net cash outflow of what? 810. That's basically what we consider there. So let's move to point number, okay, still in point number 1, the last paragraph, we are told the fair value of the non-controlling interest in 𝐻𝐒 at the date of acquisition was 340. So basically this will help us in terms of computing goodwill, but that point there is some working we need to do for the share exchange consideration. We are going to compute that. Note number 2, depreciation on PPE for the year which ended 31st of December 2023, charged to the profit and loss for 310. We are given the depreciation on PPE. The depreciation on what? On property, plant, and equipment, which is 310. That one automatically we added to that profit because it was deducted and it is a non-cash item. Number 3, during the year which ended 31st of December 2023, Bustani Limited revalued its property for a gain of 360. And then you're told Bustani Limited does not make any reserve transfer for excess depreciation. Do we consider that revaluation gain here? No. That is basically a non-cash item. But automatically, all the information we have in note number 1, 2, and 3 will help us in terms of computing the PP which were acquired. I don't think we have the inner working in relation to PP. We're going to compute the PP which were acquired using the information in note number 1, 2, 3. Number 4, the group policy is to mention non-controlling interest in all subsidiaries, including foreign subsidiary, at the fair value. And then number 5, we are told the movement in the exchange reserve relates to the retranslation of the goodwill of 80% owned subsidiary, of 80% owned subsidiary and comprises the foreign. So basically, we are told the movement in exchange reserve relates to. So remember, this basically parent company had acquired a foreign subsidiary. I think in this case, we can just ignore that information because we need to compute the exchange gain or loss. No need of doing that. We just ignore that. Number 6, we are told ignore deferred tax consequence on acquisition of subsidiary and revaluation. So I think basically that's what we have. In this case, you can see here, equally like in this question, because we have a foreign subsidiary, you may ignore things like impairment losses, maybe impairment losses on goodwill, but maybe you can check whether you have some intangible assets and the non-current assets so that you check whether you have amortization. I don't think we have intangible assets. So in this case, let's just proceed. And basically, we consider now the changes in working capital. The changes in working capital. So basically here we consider three items: receivable, inventory, and what? Payable. Receivable, inventory, and what? Payable. So we take the opening minus closing, and then closing minus opening. Minus opening. So let's just do a small summary for that, or a small working for that. So we will start with the opening balances here. The opening what? Balances, the opening balances. And then we add the receivable, inventory, payable for subsidiary, which was acquired. And then we will get the opening balances. We will get the opening balance. So let's take the opening balances first of all. Yes. So the opening balances, we have them in statement of financial position. So the opening balances in 2022 for inventory is 1290. And then receivables is what? Is 1250. Then what about payables down there where we have the current liabilities? It is basically 1690. And then to this we will add the receivable inventory for the subsidiary which was acquired, which basically is in note number 1. The subsidiary acquired, which is the 𝐿𝐎𝐄, basically had the inventory of 350, of receivable of 320, and payable of 210. And then in note number 5, what are we told? The movement in exchange reserve for losses related to the translation of net asset and goodwill of an 80% owned subsidiary and comprises the following elements. Comprises of the following elements. Was this subsidiary acquired during the current year? This subsidiary, was it acquired during the current year? Are we given information in relation to that? Are we given any information in relation to that? Let me see. That foreign subsidiary. Because you're told the movement in exchange reserve stroke losses related to the translation of net asset and goodwill of an 80% owned subsidiary, and comprises the following items. The movement in exchange related to the translation of net asset and goodwill of 80%. 80%. Automatically, if it was acquired during the current year, we must be told. So I think this only affects the revaluation. This affects the exchange reserve. So let's just ignore that, because if it was acquired during the current year, we must be told such that we should be in a position to compute the goodwill. Sasa, the goodwill in relation to acquisition of that what? A subsidiary. So let's first of all get the totals here, which basically will be considered as the opening. So this will give us what? This will give us 1570. This will give us 1640. This will give us 1900. Yes, 1900. And then we compare that with the closing balances. The closing balances for receivables is 1430. 1430. And then we have 1360. What about payables down there? 1600. 1600. Yes, 1600. So this basically is what? This one is opening minus closing. That will give us positive what? Positive 140. Positive 140. This minus that will give us negative. Huh? Yeah, will give us positive 280. And then this minus that will give us negative what? Negative 300. Negative 3 what? Negative 300. Then down here, we come and we less the tax paid. And then we also less what? The interest, which was paid. So the interest, I think this one is, in most of these particular questions, we don't have any adjustment because we don't have interest payable. We just take the amount in the income statement, this one, 160. 160. 160. Then for tax, this one we have said you must prepare the tax account. You must prepare the tax account. The tax account. If you check the preparation for this, it's just the same in almost all questions. Deferred tax, current tax at the start. At the end, deferred tax, current tax, the tax for subsidiary acquired, the tax which we have from the income statement to be credited here. And then do we have a subsidiary which was disposed? No. And then we get the tax paid. So let's record the opening balances. The opening balances, we will start with the deferred tax, which basically is under the non-current liabilities. Under the non-current liabilities, the deferred tax at the start was 1020. And then at the end is 990. And then for the current tax, which is basically below the current liabilities, we have 470 and basically 610, like that. So we go to note number 1. The subsidiary acquired had a tax liability of 40 in note number 1, subsidiary acquired. What about the tax for the current year? Above note number 1, the tax for the current year is 220. So we get this one, the tax paid. We get the tax paid. The tax paid. The tax paid. The tax paid. You're getting what? The tax paid is one what? 150. 150. Is that what you're getting? 150? Are you getting 150? 150. Mercy. Patrice, Mike, are you getting 150? Are you getting 150? Are you getting 150? I'm told by Diana, yes. Are you getting 150? Are you getting 150? Are you getting 150? Yes. So basically we have done, and I hope you can see this first part is very, very important because you can see there are so many marks here. So many marks here. So assuming, for example, these items are correct. So how many entries do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9. So assuming all this is correct and you're given 2 marks, it basically means that the first part here will just give you 18 marks. It just give you 18 marks. So that's why this part is very, very important. Very, very important. Very, very important. So we need to come here and basically we check. So automatically here we don't have any asset which was disposed. Maybe what we can compute are the dividends which were received from the joint venture. So the dividends received from the joint venture, this one will be computed using the same approach we use in computing the dividends received from the associate. So if you can be able to remember the question we did yesterday, I showed you how to compute that. So can we go to where we have the non-current asset? And the non-current asset, I'll take investment in joint venture at the start, just like what we did for the other question. The investment in joint venture at the start was 400. And then to this, we add the share of profit from that joint venture. The share of profit from that joint venture is what we had in the income statement, this one. We add it here, and then we less the investment in joint venture at the end of the year, which is 290. So basically, the difference represents the dividends which were received. That one is quite simple. The computation of that is is basically quite simple. So what are you getting here? The dividends which were received were 350. 350. So that is basically cash inflow. So then we also need to determine the PP which were acquired, because this one we can compute it with this one we can compute it. I don't think this working is complicated. So how do we compute the PP which were acquired? We can just do a small analysis here. Oh, I've interchanged those values there. Okay, thank you, Janet. So I've interchanged. I'm told I've interchanged. Yes, I should start with 290 here. 290 plus this one, and then the closing balance is 4. The closing balance is 400. Should be like that. Should be like that. Should be like that. Yes. So this one will give us 130. Yes. I want us to compute the PP acquired. PP which were acquired. So for the PP acquired, PP which were acquired, we said here we start with the opening balance. So the PP at the start. To this, we add the PP for for subsidiary acquired. For subsidiary acquired, we add the PP acquired in cash. And basically, this is what we want to compute. We add any revaluation gain. Any revaluation what? Gain. To this, we less disposal. Are there some items of PP which were disposed? In this question, we don't have any. We less PP for subsidiary disposed. In this case, we don't have a subsidiary which was disposed. We less depreciation. That also reduces the value for PP. We have depreciation in note number what? In note number 2. Depreciation is how much? Is 310. And basically, by doing that, we will get the value for PP at the end. So let's record the opening balance and the closing balance of PP. The opening and closing balance of PP, we have it within our consolidated statement of financial position. Opening balance is the value we have in the year 2022, which is 51.80. The closing balance is 75.10. So the PP for subsidiary acquired, the subsidiary acquired, we have its information in note number 1. The PP acquired, so the subsidiary acquired, its PP had a value of 820. 820. So we want to compute this PP acquired in cash. Do we have a revaluation gain in relation to the PP? Yes. The PP which were the revaluation of PP in note number 3 resulted to a revaluation gain of 360. 360. So where do we have that? We have that information in note number 3. In note number 3, we don't have disposal. We don't have a subsidiary which was acquired. So can we get the value for the PP which were acquired in cash? Which were acquired in cash. Work out all this. Automatically, it will not come to this. The difference between what you get and this one should be the PP which were acquired. And I'm told by Gilbert is 1460. So someone to confirm. Yes, so this one is coming to 6050, which is not the same with this, minus 7510. Yes, that will give us 1460. So 1460, these are the PP which were acquired, which is basically cash outflow, cash outflow. I think basically that's what we have here. Then let's come here. And remember all the items which we record here, we get them from equity and non-current liability section. So we will start with the ordinary share capital. And automatically, in this case, ordinary share capital, this one. Remember what we said, anytime the parent company has acquired a subsidiary, and part of the purchase consideration is paid through share exchange, that affects the share capital of the parent and the share premium. So automatically, we must compute the share exchange consideration, which would be quite simple. So I hope you can see the ordinary share capital one increased. So we have issue of shares, issue of ordinary shares. So in this case, the increase in share capital is 2,000, but automatically here, we are going to less the shares which were issued by the parent company to pay the purchase consideration. Let's have that working here. Basically, that one would be quite simple, because let's go back to note number one. Let's go back to note number one. We compute the shares which were issued to pay the purchase consideration. So we are told in note number one, what are we told? We are told during the year which ended 31st of December 2023, Bustani Limited acquired 75% or 100 million ordinary shares of shillings 10 par value in 𝐿. So the parent company, which is Bustani Limited, acquired 75% of 100 million shares of the subsidiary, which is called what? 𝐿 Limited. So the shares which were acquired by the parent in 𝐿 automatically are 75 million. So those are the shares which were acquired, 75 of 100 million shares. And then you're told the acquisition consideration was in cash, 80. We don't consider that. Remember that we considered that here. And a share exchange of 2 shares in Bustani for every 3 shares which were acquired. So basically, remember, you say to compute the shares issued by this company, or in our case, what we're interested with is to compute the shares issued by the parent. So we are told Bustani was to issue 2 shares for a share exchange of 2 shares. You can simplify this. You say the parent company was to issue 2 shares for every or out of 3 shares which were acquired in 𝐿. The parent company was to issue 2 shares out of 3 shares which were acquired. So in our case, we know the shares which were acquired. The shares which were acquired were 75. So we want to compute how many shares were issued by this company. So these are the shares issued by who? Issued by parent. Issued by parent company. Is that coming to 50 million? Is that coming to 50 million? The parent company was to issue 2 shares out of 3 shares which were acquired. And then you multiply that with the shares which were acquired. Now, we are saying these shares which were issued by the parents, the increase, are the shares which were issued in cash plus the shares issued to pay the purchase consideration. The shares issued to pay the purchase consideration were 50. And basically, we know that the amount which was included here was computed based on the par value per share. The par value per share is per note number one is what? Is 10 shillings. Is it 10 shillings? The par value. So remember here, we don't use the par value. Actually, we can also get that from the balance sheet. The par value is 10. So meaning the shares which were issued for cash had a value of 1,500. Had a value of what? 1,500. That's basically what we include here. The shares which were issued for cash. We do the same for the share premium. But it's also important for you to note, in that particular point, we are told when these shares were issued by the parent company, they were issued at a fair value of 12. So mean that the share exchange consideration would be equal to this times this, which should give us 600 million. So the amount now added to the share capital is 500. Is 500. So because the amount added to the share capital should be equal to the shares issued times the par value, which is 10. The amount added to the share capital is 500. the amount which is above this, which is basically 100, this one was a share premium. This one was a share what? A premium. So let's go back to the equity section. Let's go back to the equity section. So under the equity section below the share capital, we have the share premium. So the share premium in this case increased with how much? Increase in the share premium. The share premium increased from 200 to 400, an increase of 200. So out of this increase, is as a result of these shares which were issued to pay the purchase consideration, which had a value of 100. Was there any cash received out of this? No. So what we consider here are basically the shares which were issued for cash. And basically that is the share premium received in cash. Revaluation reserve, we don't consider that here. Exchange reserve, we don't consider that here. And then the retained earnings. The retained earnings, we said we use this to compute the dividends, which were paid by who? The parent company. And I think this one is quite simple because we don't have any inter-reserve transfer. We will take the retained earnings at the start, just like what we did for the other question, the question we did yesterday. The retained earnings at the start, which is 1170. I hope you can remember the formula which I gave you, 1170. And then to this, we said we add what? The profit for the year attributable to the parent. Profit for the year attributable to the parent company or attributable to the group. This one, we have it in the consolidated statement of profit or loss. Profit for the year attributable to the owners of the group. To the owners of the group, I can see that is a figure of 440. I hope you can see that. Profit for the year attributable to the owners of the group, 440. And then to this, we left the retained earnings at the end. The retained earnings at the end of the year is 1240. So basically that will give us the dividends which were paid by the parent. The dividends which were paid by the parent, I'm told by Diana here, is 370. 370. Yes, so below that we have NCI. NCI is for use, we use that in computing the dividends paid by NCI. I think we can just ignore that. And then finally we go to where we have long-term, non-current liabilities. At the non-current liabilities, we have one item, long-term loan. So the long-term loan, we need to see whether we have an increase or a decrease. And automatically, in our case, we have an increase from 1590 to what? To 2070. An increase of what? For 80. So basically that is a loan which was acquired. A long-term loan which was acquired. But in this case, remember you have said, in case the subsidiary which was acquired was having a bank loan, you need to eliminate that here. And I don't think that, yes, the subsidiary was not having any liability, any loan, that is, any loan. And I think we are done. I think we are done. So that question, basically, if you do it like that, this is a question you'll have completed. You can be able to complete within 40 minutes, and basically will be having all the marks. So how many entries do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. 18. So basically, this is a question you can see, is a question you can be able to do within a very short period of time, and you're able to score all the marks. Yes. So that is it. That is all about that subtopic regarding the presentation of cash flows. And basically, that also brings us now to the end of that topic of group accounts. So maybe once we meet, that is, we have another class on that is on Saturday. I'll basically be able to see maybe what may be remaining. I think we have some small topics now which are remaining, like the financial statement of insurance company. Maybe that's what we will be covering on Saturday, such that maybe next week we should start our revision officially. Although like the theory topics we have not been able to discuss on that, maybe we are going to do that as part of our revision. Yes. So we stop at that point for today. We continue from there on Sunday, that is on Saturday, as we look on how we prepare the financial statement of insurance companies. Sawa. Yes, so let's continue from there on Saturday. Have a good night. Yes, and I think we're going to start by computing the net actuarial gain or losses. The net actuarial gain or losses. So we compute 3 items here. So the first one, I've said we compute the net actuarial gain or what? Losses. Number 2, we compute the net pension cost. And number 3, we compute the net defined benefit liability stroke assets. So let's start with the first one here. The net actuarial gain or what? Or losses. And we say that this is the net actuarial gain or losses on the net defined benefit what? Obligation. On the net defined benefit what? Obligation. So how do we compute this one? You have to remember, I gave you a format for computing this one. We said always here we start with the net defined benefit obligation balance brought down. And actually we say that this particular value may be given. In some instances, the examiner may not give you this particular value. So in case you're not given this particular value, we said what we do is that we take the present value of the defined benefit obligation at the start of the year. And then to this, we less the fair value of the plan assets. The fair value of the plan asset at the start of what? Of the year. That's what we start with. And then to this, we add something called the net interest cost. And actually, we say that this particular net interest cost is computed using now the interest rate of high corporate bonds. And actually, we multiply that with the opening balance here, with the net defined benefit obligation at the start. And then to this, we add 2 other items, the current service cost, of which we say that this can also be known as purely the service cost. The examiner may use any of the words there, the current service cost or just the service cost. To this, we also add the past service cost, and then finally to this, we less the contribution which was paid to the retirement benefit scheme. So after working all this, we said we get something called the expected, and actually this should be the net defined. So we get something called the expected net defined benefit obligation balance carried down. Remember, balance carried down is at the end of the year, and then we compare this with what if are the net defined benefit obligation balance carried down, which is basically at the end of the year. And we said any difference between these two values, then it is called the net actuarial gain or losses. The net actuarial gain or loss. So we said after comparing these two values, if, for example, you have an increase here, that will be a net actuarial loss. But if we have a decrease, then that is a net actuarial gain. So let's just have these particular figures here. So we start with this one, the net defined benefit obligation at the start of the year. So if we go back to this particular question, specifically in paragraph number 1, we are told Volta Limited operates a defined retirement benefit plan for its employees. And then you're told on 1st of January 2014, which is now at the start of the year, the fair value of the pension plan asset was 2.6, and the present value of the plan liabilities was 2.9. So you can see what you're given at the start of the year. We are given the fair value of the plan asset, and also we are given the present value of the plan liability. So the present value of the plan liability, present value of plan liability, we said that this is the same with the present value of the defined benefit obligation. So the examiner may use any of the word plan liability or defined benefit obligation. So therefore, how do we compute this value here? So we will take the present value of the plan liabilities, which is 2.9, and then to that we less what? the fair value of the plan asset. So the fair value of the plan asset still in paragraph 1 is given as 2.6. So meaning that the net defined benefit obligation at the start of the year was how much? Was 300,000. Was 300,000. 300,000 like that. Was 300,000 like that. 300,000 like that. 300,000 like that. So Ken, what is happening from your end? Ken, what is happening? Anyone having a problem with getting my video other than Ken? Yes, Erastus, you can, is my video okay? Susan, Virginia, is my video okay? Okay, so can check what is happening on maybe your end, maybe it is your internet which is a little bit slow. So if your internet is slow, you'll have a problem with getting my video. So maybe you can just exit and then you rejoin, you see whether there is any improvement. Okay, so let's proceed. So therefore, what I've said is that the examiner may have given you this particular value here, or if that value is not given, that is the net defined benefit obligation at the start, automatically the examiner will give you these two items: the present value of the plan liability at the start and the fair value of the plan asset. So therefore, to compute this one, you take the present value of the defined benefit obligation minus the fair value of the plan asset, and then you next we compute the net interest cost, which I'm saying should be computed on the interest rate of high corporate bonds. If the examiner has not given you that, the interest rate of high corporate bonds, the examiner will either give you something called the discount rate. So that is the rate which we apply to compute this. So therefore, in our question here, I think in paragraph number 4, we are given the interest rate of high corporate bonds, which is 8%, and this should be 8% of this, 8% of the defined benefit obligation at the start. So 8% of 300,000 will give us what? 8% of 300,000, is it 24,000? Yes, 24,000. So, and then to this, we add these two items, the current service cost and the past service cost. And these two values are given in paragraph 2. We are told that actually estimated the current and the past service cost for the year which ended 31st of December 2014 to be 450,000 and 80,000. So 450 is the current service cost. The current service cost here is 450,000. What about the past service cost? The past service cost is 90,000. And remember, we said that this past service cost we added here in case there was any, because we said, if you can be able to remember by definition, we said that the past service cost, we said that this is basically increase in the amount of pension which will be paid to the employees in the future if there was an improvement during the current year. What is an improvement? An improvement, basically, we said, is whereby, for example, you secured a job with a company, with an employer, and your employer promised to pay you a pension of 5 million by the time you'll be retiring. But because you have been performing, or your performance has been okay, you have been committed, you have been a very hardworking, committed employee, then your employer decide to increase your pension from maybe 5 million to 8 million. So that is called an improvement. So therefore, past service cost only arises whereby there was an improvement which occurred during the current year. If there was no improvement which occurred during the current year, then you will not be given the past service cost. That's why we say we add the past service cost, if any. And that's why, if, for example, you go back to the question, the paragraph 2, the last sentence, we are told the past service cost is caused by an improvement in the pension benefit commencing that first. So there was an improvement during the current year. That's why we are given this. And then next, we list the contributions which were paid. The contributions which were paid is given in, I think, the second paragraph from last. The second paragraph from last, we are told, is at the year end, fair value, not that, okay, I think it should be in paragraph number 3. Paragraph number 3, we are told the pension plan paid shillings 240,000 on 31st of December 2014, and on the same date, Volta Limited paid shillings 730 in contribution. So in our case, what we are interested with are the contributions which were paid 730. So what you're given 240, these are benefits which were paid, benefits paid to the employees who have already retired. And actually we say that this particular benefits paid, there is nowhere we use it in computing any of these three items. Sasa? Yes. So I think what then we need to do is we work out all this and we get now the expected net defined benefit obligation at the end of the year. So give me this a particular figure here. You work out all this. You give me the figure here. And we try to hurry up so that at least we can do a number of questions. I want us we do at least a question from this topic of employees benefits, a question from the topic of share based, and also maybe a question from the topic of earnings per share, EPS. So we try to hurry up. Yes, so this will give us 134,000. 134,000. Okay, 134,000. Okay, so then what we need to do is to compare this, whatever you have here, with the net defined benefit obligation at the end of the year. Are we given this one? No. But if you go back to the second paragraph from last, we are told is at the first of all, as at the year end, the fair value of the pension plan asset was 3.4, and the present value of the plan liabilities were 3.5. So basically, it means that we can be able to compute this the same way we did here at the start of the year. So we take the present value of the plan liability, which is 3.5 million, minus the fair value of the plan asset, which is 3.4. So this will give us what? This will give us 100,000. Sasa? Yes. So then what we do is that we compare these two values. We determine from this to this value, do we have an increase or a decrease? In our case, I can see we have a decrease of what? Of 34. From 134,000 to 100,000. That is a decrease of what? Of 34,000. And actually, remember what we said is that a defined benefit obligation, this is a liability. So what happened if, or basically a decrease in the liability, because this is a decrease in the value of the liability, we said that this is a gain. So therefore, this one, we refer to it as the net actuarial gain. But if it was an increase, for example, we had 134,000 here, and maybe here we had 200,000. So I mean that we had, this is basically an increase of what? Of 66. So anytime the value of variability increases, that is a loss. That is what? A loss. So therefore, an increase is a loss. A decrease is what? Is a gain. So therefore, that's basically how we compute the first item there. The first item there. So the net what? Actuarial gain or loss. So let's compute the other item number 2. The net pension cost. The net pension cost. And actually, before we compute this one, you have to remember we say that this particular net actuarial gain, this one is recognized. This one is recognized as a part of other comprehensive incomes, in the income statement. In the income statement, or in the statement of profit or loss. Now, what you need to know is that when we talk about other comprehensive incomes, these are basically what? These are the other incomes of the company which should not be included in the profit for the year. Sasa? Yes. So let's determine this. The net pension cost. We say that this one is quite simple because here we add these 3 items here. So we add those 3 items and we get something called the net pension cost. So we will just bring those 3 items here. The net interest cost, which is 24,000. The current service cost, which is 450. And remember what you have said is that the examiner can also refer to this as service cost. If you're given the service cost, you need to know that is the current service cost. And then to this, we add the past service cost. The past service cost in our case is what? Is 90. So basically, by adding those three items, we get something called the net pension cost. The net pension cost, I think this will be 5 what? This will give us what? 560. Is it 564? 564. 564. 564. 564. 564. Yes. So basically, this particular 564, this one is recognized as an expense in the income statement. This one is recognized as an expense in the income what? In the income statement. So then number 3, we are required to determine the net defined benefit assets, the net defined benefit assets, stroke what? Stroke liability. So this is something we have already computed here, but basically we can show how we can compute it there again. So how do we compute the net defined benefit asset or liability at the end of the year? So what we do is that we take the present value of the plan liability, Remember, we have said that the plan liability, this can also be known as the defined benefit obligation. Defined benefit obligation, specifically at the end of the year. At the end of the year, balance carried down. Balance carried down is the balance at the end of the year. And this is now what we have in our question, I think, in the second paragraph from last. The fair value of the present value, that is, of the plan liability is given as 3.5. And then now to this, we less the fair value of the plan assets. The fair value of the plan assets still at the end of the year. And also it is given in the same paragraph, the second paragraph from last, which is 3.4. And because in this case, you can see this liability, because this liability is more than this is more than the plan asset. Whatever you have here, which is now 100,000, we refer to this as the net defined benefit liability. Benefit what? Liability. The reason why we are referring to it as a liability is because this liability is more than asset. So, and actually this one we said is recognized in statement of financial position as a non-current liability. As a non-current what? Liability. As a non-current liability. Sasa? Yes. So that is it. That basically what was required in that question. So therefore, that's how these particular questions are tested. And actually, those are usually the 3 items you may be required to compute. And equally, the examiner may require you to explain how to account for each of those items. So we have said the net actuarial gain or losses, this one is recognized as part of other comprehensive incomes in the income statement. That one is recognized as an expense in the income statement. This one is recognized as a non-current liability in the statement of financial what? Position. So that is it, that what is required in that question. Yes, so I want us to look on another question regarding share-based payment. And I want us to look on a question still which was examined some time back. Remember, we said that these are some of the questions which have high chances of being repeated. Which have high chances of being what? Being repeated. Now, this should not be done separately. As per the revised IAS 19, we don't compute the actuarial gain or losses separately, because previously we were computing the actuarial gain or losses on plan assets and also the actuarial gain or losses on the plan liabilities. That previously what used to happen. But as per the revised standard, this is the approach to be used. Sasa? Yes, this is the approach to be used. If you check on some questions which were examined some time back, you will see the examiner was requiring the computation of actuarial gain or losses for for plan asset, for plan liability separately, but as per the revised standard, IS 19, this is how it should be done. In fact, if you check, I think the most recent questions on this, you will see you are not even given the fair value of the plan asset. You are not even given the present value of the plan liability. So the examiner will give you this. Sasa, yes. So therefore, this is the approach to be used, not the old approach, because the one you're asking about, that is the old approach of computing this, or not the old approach actually, and that's what was done before this standard was revised. You can see there is some information which we are given there that under the revised IS 19, this standard was revised. To revise a standard is to make some changes to a standard, and the standard, I think, was revised in 2011. So that is the approach. That's what you need to remember here. Yes. So let's look on this question here. Question 4. Question 4 of May 2016. May 2016. Yes, some of the information which is given there, like the benefits which were paid, I've said under the revised standard we don't need that information. Yes. So just understand that approach. That is the approach which should be used. And I think you can check there are some questions I think tested in 2022, 2021, if I'm not wrong. 2022, 2021, there are two questions or there are questions coming from this topic. You'll actually see the examiner will not even give you the fair value of the plan asset, the present value of the plan liability. Because you should use that particular approach. So I hope you're here. You already have this particular question with you. Question 4 of May 2016. And I want us specifically look on not the whole question, but specifically part C, because I want us to remind ourselves regarding the share-based payment. Are you there? Are you there? Are you there? Okay, so the question is, XYZ Limited issued share option to staff on 1st of January 2013. The details relating to this share option are as follows. So we are given the number of staff, 1,000, number of option to each member of staff, 500, vesting period 3 years, fair value at the grant date per option, during 30, expected employees turnover per annum, 5%. And then we have some additional information. Number 1, we are told, in the financial statement for the year which ended 31st of December 2014, the company revised estimate of employees turnover to 8% per annum for the 3 years vesting period. And then number 2, we are told in the financial year for the year, in the financial statement for the year which ended 31st of December 2015, the actual employees turnover had averaged at 6% per annum for the 3 years vesting period. So options, number 3, options vest as long as the staff remain with the company for 3 years period. So what are we required to do? We're required to compute the amount to be charged or the charge to be made to the statement of comprehensive income for share-based payment in conformity with IFRS 2 share-based payment for each of the year which ended 31st of December 2013, 2014, 2015. So basically, this is a question from the topic of share-based payment. A question from the topic of share-based payment. This is also basically another common topic in this particular exam. But usually the questions which come from this particular topic are small questions, carrying between like 6 marks, 8 marks, or even like 4 marks. So what do you need to remember here very fast? You need to remember, first of all, what is a share-based payment transaction. Basically, a share-based payment transaction, we said, is a transaction whereby a company will receive some goods, or basically the company is provided with some services by a counterparty. A counterparty. The counterparty is the supplier, who is the supplying goods to the company, who is providing the services to the company from a counterparty. And the company pay for these particular goods or services, one, by issuing its own shares. So here, once the supplier supply the goods to the company or the services, he may be paid by being issued with the shares, or number two, he can be paid some cash, and the cash he will be paid here is equivalent to the fair value of a certain number of company shares. Certain number of company shares. So mean that if you are a supplier here, and then you have entered into a contract with this company that you are going to supply some goods to this company or provide services, you are going to agree that you are going to be paid cash. But the cash you are going to be paid will not be equivalent to the value of the goods or services you have provided. It will be equivalent to the fair value of certain number of company shares. So that transaction whereby you are paid by being, or whereby you are paid by the company by being issued with the shares, or you are paid a cash which is equivalent to the fair value or the market price of certain number of company shares, we refer to it as a share-based payment transaction. Equally, you need to remember you have 3 types of share-based payment transactions. Number one, we have equity settled share-based payment transaction. This is basically a transaction whereby the company will receive some goods or services, and the company pay for those goods or services by issuing shares. So the mode of payment here is shares. Number two, we have the cash. Actually, this one we refer to it as equity settled. Remember, equity settled share-based payment transaction. Number two, we have the cash settled share-based payment transaction. So here, the company receives some goods or services, and the company pay for those particular goods or services in cash, but this cash is equivalent to the fair value of certain number of company shares. And number three, we talked of a transaction where there is a choice, where there is a choice of settlement, where there is a choice of cash or equity settled payment. Or basically, you can just talk of a transaction where there is a choice of settlement. A transaction where there is a choice of settlement. So these are transactions whereby as a supplier, you supply goods to the company, or you provide services to the company, but it is upon you to choose. Do you want to be paid by being issued with the shares of the company, or do you want to be paid in cash? Sasa, you choose. You have to choose. So therefore, we have those 3 types of what we refer to the share-based payment transaction. And actually, we said a good example of this is what we refer as the employees. The employees are share-based. The employee share-based payment. Employee share-based payment is basically whereby the employees of the company will provide services to the company, and basically they are issued with the shares of the company free of charge, or they can be paid some bonus or some cash in the future, which would be equivalent to the fair value of certain number of company shares. And therefore, this particular question here, it was basically testing on that. So I think maybe that and some of what you need to remember as far as that topic is concerned. Yes. So coming back to our question here, what are we required to do? We are required now to compute the charge to be made in the income statement. The charge to be made in the income statement, or the statement of comprehensive income. to be made in the statement of comprehensive income for 3 years. So when talk about the charge to be made in the income statement, we are talking of the amount of expense to be recognized in the income statement in the vesting period. In the vesting period. In the vesting period. Now, there is a formula which I gave you here, which we said you need to remember because that is the formula you should use in computing the amount of expense. We said what you need to do, number one, is or we take the number of employees, who are expected to remain, and then you multiply that. But remember, I said that this one will help you in terms of computing the cumulative expense at the end of each year. So you take the number of employees who are expected to remain, you multiply that with the number of options, which are given to each employee, and then multiply that with the fair value of each option, and then you multiply this with the proportion of what? Proportion of time. Proportion of time. So this is the formula which basically we use in computing the amount now which will be recognized as an expense in the income statement. Number of employees who are expected to remain, the number of options per employee, fair value of each option, and then the proportion of time. And actually we said all these items here, all of them will be provided. What the examiner will not give you, and what now keep on changing in different questions is how you determine this. Actually, we said this whereby this is the only tricky area. If you check on the different questions coming from this topic, you'll be able to see that the information given by the examiner and which is used in determining this, that information is different. Yes. So therefore, what we need to do is this one, because we don't have it. And actually, because we are required to determine the amount to be expensed in the income statement for 3 years, 2013 in the requirement, 2014 and 2015. So what we need to do is we need to determine the number of employees who are expected to remain at the end of the vesting period in each of those 3 years. So let's start with the first year, which ended 31st of December 2013. So what we need to do is to determine number of employees expected to do what? To remain. Expected to remain. So when talk about the number of employees who are expected to remain, we are talking about those particular employees who are expected to be working with the company at the end of the vesting period. Remember, the employees were granted this option or this particular right on 1st of January 2013. And then you're told just below that, the vesting period are 3 years. Vesting period means that for the employee to be entitled to buy the shares of the company, then in this case, he must work with the company for the next what? For the next 3 years. For the next 3 years. And if there is something we have forgotten here, sorry for that, what we said is that once you come across this particular question, the first thing you need to do is basically to indicate whether, or basically to check whether this employee's share option is an equity settled, an equity settled employees share option. We say this whereby the employees have been granted a right to buy the shares of the company in the future at a price below the market price. That is what you need to check. This can be equity settled or can be cash settled. So when talk about cash settled employee share option, we say that this whereby the employees will be paid a bonus, or basically a cash in the future, and which is equal to the fair value of certain number of company shares. So here we are saying that the employees have been given an option to do what? To buy the shares. So if you go back to the information which you're given in that question, specifically in paragraph 1, we are told XYZ Limited issued a share option to the staff on 1st January. So this is a share option. A share option means what? A share option means that the employees have been given an option, have been given a right to buy the shares of the company at the end of the vesting period, basically at a price below the market price. So if that is the case, the employees have been given an option to buy the shares, then we can say that this is an equity settled. So therefore, that is the first thing you need to identify, because that will actually determine the fair value of each option you're going to use here. So this, we can say this is an equity settled employees share option. Employees share option. That is the first thing. Yes. So I think having that, now we can come back here. We determine the number of employees who are expected to remain at the end of the vesting period. Remember, in this case, we have 3 years, 2013, 2014, 2015. So we want to determine how many employees will be working with the company at the end of 2015, because those are the employees who will be entitled to do what? To buy the shares of the company. Now, let's go back to the information you have at the paragraph 1, and you're given the data relating to the share option. First of all, you're given the number of staff. These are the original number of staff, 1,000. And then you're told the number of options per staff, or per staff is 500. Vesting period 3 years. Fair value at the grant date 30. And then the employees, or the expected employees turnover per annum. Expected employees turnover, those are the employees who are expected to leave the company per annum. So we are told the expected employees turnover is what? 5%, and that is per annum. So therefore, for us to determine the number of employees who will be working with the company at the end of 2015, we need to take the original number of employees who are there, 1,000, and then we less now the employees who will leave the company in the next 3 years. So in this case, we are told the employees who are expected to leave the company is 5%, automatically 5% of 1,000, and this 5% we are told is per annum. Can you see that? Per annum. So in our case, what we're interested with are the employees to leave the company in 2013, 2014, 2015. And this now will give us the number of employees who are expected to be working with the company at the end of the vesting period. At the end of the vesting period. So this will give us what? This is 50 times 3, which is 150. 150, we deduct that from 1,000, which will give us 850 employees. So these are employees who are expected to be working with the company at the end of 2015, as per the first year. So we also need to do the same in 2014, because if you go to the information that we have in the addition information number 1, in addition information number 1, you're told in the financial statement for the year which ended 31st of December 2014, at the end of 2014, the company revised its estimate of employees turnover to be 8% per annum for 3 years period. So in 2013, the company was expecting the number of employees to leave per annum would be 5%. In 2014, we are told the company has revised that to 8%. So therefore, we equally need to do the same here. We need to determine the number of employees expected to remain as at the end of 2014. So we are going to take the original number of employees, 1,000, minus now the employees who are expected to leave the company per basically over the vesting period. In this case, we are told in 2014 the company revised that to 8%. So 8% of what? Of 1,000 times what? Times 3. Times what? Times 3. This will give us what? This will give us 80 times 3, 240. 240, we deduct that from 1,000. Is it coming to that one? Is it coming to 760? Is it coming to 760? 760, 760. 760. Okay, sawa. And then in the addition information number 2, we are told in the financial statement for the year which ended 31st of December 2015, the actual employees turnover had averaged to 6% per annum. So basically what that means is that at the end of 2015, the company now, we are told, or basically at the end of 2015, it's obvious that the company know the employees who left in 2013, 2014, and 2015. That's why we are told the actual employee turnover had averaged to 6%. So basically, it means that in this year, what we need to do is to determine the number of employees who actually remained. These are the actual employees who are working with the company at the end of 2015. So we take the original employees, 1,000, and then you're told the actual employees turnover had averaged to 6% per annum for a period of 3 years. So this will give us 60 times 3, which will give us 180, and that will give us what? 820 employees. So I think once you're able to crack this one, because we said this is the only tricky area. Once you're able to crack this one, then we say these particular questions becomes then a little bit what? Simple, becomes simple. And then from there, I think we can proceed and answer our question. So what you're required to do is to determine the amount to be charged in the income statement. This is the amount to be recognized as an expense in the income statement. And actually we said for us to do that, this is how we arrange our work. We need to have the 3 years. The first year ended 31st of December 2013. So the other year ended on 31st of December 2014. And then the other year, 31st of December 2015. So we need to have a column here for something called the cumulative expense. Cumulative expense here. Cumulative expense. And actually this one, we computed using the formula which we have up here. Remember, I said this expense is for computing what? The cumulative expense. And then finally, we have another column here for the amount to be recognized as an expense in the income what? The amount to be recognized as an expense in the income statement. So we start by computing this using the formula which we have up here. So we need to take the number of employees who are expected to remain at the end of each year. And actually, that is what we have determined here. In the first year, the employees are expected to remain 850, in year 2, 760, in year 3, 820. We multiply that with what? We multiply that with the number of options per employee. The number of options per employee, we have that in the paragraph 1. Number of options per employee, that is given as a figure of what? Number of options per employee is given as what? Is given as 500. 500. That will not change. That will not change. And then we multiply that with the fair value of each option. This is another area we said you have to remember something. We say that if, for example, the employee share option is an equity settled, the employees have been given an option to buy shares at the end of the vesting period. Then we said that we use the fair value of each option, the fair value of each option at the grant date. So in our case, we already have this at the paragraph 1. But on the other hand, we say that if the employees have been given or will be paid a cash or a bonus at the end of the vesting period, so mean that is a cash settled employees share option. We use the fair value of each option at the end of each year. End of each year. So, and that's why we say it is very, very important for you to identify which type of employee share option is this. So like in our case, we said is an equity settled. So if it is an equity settled, it basically means that in computing the cumulative expense and also the amount to be expensed, we are going to use the fair value of each option at the grant date. And that one, we have it at the paragraph 1. Fair value of each option at the grant date, which was 30. That will not change. 30. But now I'm saying if this was a cash settled, then what we use here is the fair value of each option. And actually we said the fair value of each option, This one is equivalent to the market price of each share. The examiner can give you either this one or that one. Sasa? Yes. So the fair value of each option is equal to the market price on actually the fair value of each share, of each what? Share. So that one will not be changing. So, and then finally we multiply that with the proportion of time. Proportion of time. What is the proportion of time? Proportion of time here, first of all, we have 3 years. So in the first year here, we're interested with the amount to be expensed in the first year, because basically this will give you the expense for 3 years, the amount to be expensed in the 3 years. So, but in the first year, we're interested with the amount to be recognized as an expense in year 1 out of 3. Here, 2/3, here 3 out of 3. That is now what is as the proportion of time. So give me the figure here for the first year. For the first year, what do we have? What do we have in the first year? We have 850 times 500 times 30 divided by 3. Yes, I'm getting 4250,000. Yes, and actually we said in the first year, this is now the amount which is also recognized as an expense in the income statement, which is also recognized as an expense in the income statement. So what about year 2, 760 times 500 times 30 times 2 divided by 3, which will give us 7.6 million. 7.6. Okay, so then how do we determine the amount to be expensed here? We said that should be the difference between the cumulative expense in year 2 and year 3. The difference between these two values here. That will give us a value of what? 350,000. That is 350,000. That's how we determine the amount to be recognized as an expense in that year. Then let's get the cumulative expense at in the year 2015, 820 times 500 times 30, which will give us what? 300,000, 12.3 million. So that is the amount to be recognized as an expense there. Not to be recognized as an expense, but that is the cumulative expense. The cumulative expense at the end of 2015. So how do we determine the amount to be recognized as an expense in the income statement? The same. So we take the difference between cumulative expense at the end of 2015 and 2014. The difference between these two values there. That will give us what? Is it 4.7? Yes, 4.7. So therefore, that is what was required. The charge, the amount to be charged in the income what? The amount to be charged in the income statement. Remember, there are some questions equally whereby the examiner may also require you to do what? To make the journal entries for this, to show how was this amount supposed to be recognized, sorry, to be accounted for, or basically what is the double entry for this expense here. So we said in case you're required to show the journal entries or the accounting entries for this particular amount here, you must make a journal entry at the end of each year. For example, this particular amount to be recognized as an expense in the first year, we said this one should be debited in the income statement. Being debited in the income statement means that in the income statement, it is recognized as an expense, the figure of 4250,000. And then in this case, we said we credit something called the equity. We credit an account called what? Equity. Sasa? Yes. So you do the same at the end of 2014 and at the end of 15 with this particular amount. For example, in 2014, you do what? You debit the income statement with this amount, that is 50,000, and then you credit the equity, that is 50, that is 350. So the same case with that particular amount. Sasa? Yes. So I think that is it. That what was required in that particular question there. that particular question there. That is what was required there. But show an example if the employees exercise their options. Now, in this, there is, I think, a question we did in class whereby some of the options were exercised. I think so. So maybe I don't know whether that question is part of the videos I shared with you. But I think I'll check if it is not part. Maybe I'll try and look on a question whereby we have a question whereby some of the options were exercised. Yes, I think maybe it is part of that. It is part of the videos which I shared with you. So therefore, that is it. That what was required as far as that question is concerned. But now, assuming this, for example, was a cash settled, it was a cash settled. What would be the difference in terms of how we determine the cumulative expense? We determine the amount to be expensed in the income statement. So if this was a cash settled, we use the same formula in terms of determining the cumulative expense. But one of the main difference would be this one. When computing the amount to be expensed, we say that we use the fair value of each option at the end of each year. Mostly what the examiner will have given you is the market price of the company shares at the end of 2013, at the end of 2014, at the end of 2015. That is now what you come and use here. So the market price of the company shares at the end of year 1, at the end of year 2, at the end of what? Year 3. That is one of the difference. The other difference is that this particular amount which you will compute here as the amount to be recognized as an expense, how do we account for it? We debit the income statement, but in this case, we don't credit equity. We said we credit liability. We credit what? Liability, simply because at the cash settled, the company do not have an obligation to issue equity shares. The company has an obligation to pay cash or a bonus. Cash or what? A bonus. So basically that is the difference. So therefore, that's basically what you need to recall as far as this is concerned. Remember, we are saying that this is also another area which is likely to be examined. Actually, if you check on the past papers, you'll see that in almost all sittings, usually there is an area which is usually tested. But if you're able to determine the number of employees who are expected to remain at the end of each year, then I think we say that is a tricky area as far as these as far as questions coming from these particular topics are concerned. So I think that is it. Then can we look on this particular question? I don't know whether we will be able to finish the entire question. Is a question which is a little bit long. Now, equally, you can confirm whether we did this question in class. The question for earnings per share, but I don't think so. I don't think so. So a question from the topic of earnings per share. So this topic was examined last sitting. It was examined last sitting, but you never know. It is also another very common area which may also be repeated, even though there was a question on this last sitting. So let's go to this particular question here. 2017, which is question number 3. Question number 3. Are you there? Are you there? Okay. So the question leads. This is basically a question from the topic of earnings per share. It leads. Juhudi Limited is an electronic company which has been listed in the Securities Exchange for the last 2 years. Provided below are the equity and long-term fund of the company as at 30th of April 2016. So also provided are the income statement and the statement of movement in reserves for the year which ended 30th of April 2016 and that is April 2017. So we have equity and long-term funds as at 31st, that is 30th April 2016, where we have ordinary share capital, share premium, 6% preference share capital, retained profit, and then we have the total equity. We have the long-term fund, which include 8% convertible loan stock. We have the total equity and non-current liabilities. Then down here we have the income statement for the year which ended 30th of April 2017 and 2016. So first of all, we have revenue, cost of sales, gross profit, operating expenses, profit before interest and tax, interest on loan stock, and then we have profit before tax, we have taxation, we have the profit for the year. Then down here we have the statement of movement in reserves. This what in other terms we refer to the statement of changes in equity. So for 2017-2016, we have the retained profit brought forward, profit for the year, preference dividends, ordinary dividends, and the retained profit carried forward. Then we have some additional information number 1 to note 6. And then what are we required to do? We are required to compute the basic earnings per share for the year which ended 30th of April 2016. And Roman part B, basic earnings per share for the year which ended 30th of April 2017. Roman part C, adjusted earnings per share for 2016 that would be shown in the year 2017 as a comparative earnings per share. And then part D, diluted earnings per share. Diluted earnings per share. So let's start with the part A of that particular question, whereby the examiner was requiring the candidate to compute the basic earnings per share for the year which ended 30th of April, 30th of April 2016. So how do we compute this particular basic earnings per share? You need to recall the formula. We take the PATOS, the profit attributable to ordinary shareholders. We divide that with 1/8, weighted average number of ordinary shares. So that is the formula which we use here. But equally, it is also important for you to note that in this particular question, we have information about 2 years, the year which ended 30th of April 2016 and 30th of April 2017. So even year is ending April, it basically means that the next year will start on May. So this year started May of 2015. And then the second year here, the second year started on 1st of May 2016. So therefore, what we are required to do first of all is we compute the earnings per share for the first year here, and then we compute enrollment in part B, we compute earnings per share for 2017. So let's start by determining this profit attributable to ordinary shareholders. And actually we say that this one is determined by taking the profit after tax, which is also known as the net income, which is also known as the profit for the year, So the examiner may use any or may give you any of those. So, and then to this, what do? We less the preference dividends, preference dividends for the current year. And it also, if you're computing the earnings per share for a group of companies, to this we also less the profit attributable to the non-controlling interest. Profits attributable to non-controlling interest. And equally, there are some questions whereby you may be told that this particular profit for the year which you are given here, for example, include loss from discontinued operations. So when talk about the discontinued operation, I hope you know what is this. A discontinued operation is an operation of a company which has been discontinued. It can either be a branch which has been closed down because it is making losses. In a group context, this is a subsidiary which has been fully disposed. A subsidiary which has been disposed. It is Sasa, yes. So let's go back to and basically the information about the profit we get it from the income statement. So the income statement is under paragraph 1. So below where we have the equity and long-term funds, below that we have the income statement for 2016-2017. So we take the income statement, or we go to the income statement for 2016, And I hope you can see those figures are in thousands of shillings. So what is the profit after tax, or basically the profit for the year? For 2016, the profit for the year in that income statement is 3630, which is now the profit for the year. To this, what do we need to do? We need to less the preference dividends. So are we given the preference dividends? The preference dividends, you can compute it. You can compute it. So if we are not told that the profit includes the loss, we use it. If we are told that the profit after tax include losses, we use it. No, I'm saying, I think I've explained what we do with that loss. If you're given the profit, for example, you're given this profit and you're told it include a loss from discontinued operation, we are saying that loss, you come and you add it back. You add it here. You add it to this, because in arriving at this profit, the loss was deducted. And because we use, when computing the earnings per share, we use the profit from the continuing operations. So the loss, you add it what? Back. That's yes. So in this case, then below that income statement, where we have the statement of movement in reserves, we have the preference dividends. And the preference dividends are given as 30. But also you have to recall what we said as far as these dividends are concerned. We said there are some questions whereby you can be told the preference shares issued by the company are redeemable preference shares. So if the preference shares issued are redeemable, we said don't deduct those particular, or don't deduct the dividends for these particular shares here, because dividends on redeemable preference shares, these ones are classified as part of the finance costs. In arriving at this profit for the year, the finance cost has already been deducted, and it includes dividends on redeemable preference shares. Yes, so we have that. Then in this particular question here, this is basically not a group of companies. We don't have the profit attributable to NCI. Equally, we don't have we don't have loss from discontinued operation. So meaning that the profit attributable to ordinary shareholders is what? Is 36. So then from there we need to move, and we compute now the one-off weighted average number of ordinary shares. So this one we said basically we compute this by taking the number of ordinary shares which were issued at the start of the year. We add the other shares which the company issued during that year. And basically what you have said is that this year started on 1st of May 2015. So we need to determine how many shares had been issued at the start of the year. So which information do we have here? Which information do we have, and which will help us in determining that? Maybe first of all, we can go to the addition information. We see what you're told. Can we go to the addition information number 1? In addition information number 1, you're told on 1st of November 2016, the company made a bonus issue of shares on the basis of 1 ordinary share for every 6 shares which were held. 1st November 2016. Now, 1st November 2016, does that fall within the first year, or that is a transaction for the second year? November 2016, automatically that is within the second year. That is within the second year, because you can see the first year ended 30th of April 2016. So November 2016 is a transaction for the second year. Number 2, we are told on 1st of March 2017, the company made a right issue. 1st March 2017. Still, that is a transaction for the second year. And then number 3, we are told the 8% convertible loan stock can be converted at the option of the holder from the year 2022 at a ratio at that particular rate. Okay. And then, okay, that has nothing to do with the ordinary shares. Number 4, we are given the corporate tax rate. Number 5, we are told there are no issue of preference shares. And number 6 is about there are no issue of loan stock. So basically, those two transaction number 1 and 2, they occurred during this year. So basically, it means that during this year, the first year, we're not given any transaction regarding the shares which were issued. And what does that mean? It basically means that the shares which were issued at the start of the first year here were the same with the shares issued at the end of the year. And where do we get the number of shares which were issued by the company during the first year, the year which ended 30th of April 2016. So this information, we get it at the paragraph 1. Can you go to and to the information we have at the paragraph 2, not paragraph 1. In paragraph 2, we are told also provided the income statement and the statement of movement in reserves for the year 2016. The year ended 30th April 2016. That is the first year. So below there, where we have the equity and long-term fund, we have the ordinary share capital. The ordinary share capital of the company at the end of the year here, is 19.2. This, remember, is the ordinary share capital. So we are going to use this in computing the shares which were issued at the end of the year. To compute the shares issued at the end of the year, we take ordinary share capital, 19.2, we divide that with the par value per share, which is 8. So that will give us now the shares which were issued at the end of the year. This will give us what? Will give us what? 2,400. So basically that means that the shares now which were issued at the end were 24. And remember, take into account there is no any transaction you're given which occurred during this year in issue to issue of shares. The shares issued at the start and at the end were the same. So basically that means that the shares equally which were issued at the start of the year were 24, because we have said during this year there were no shares which were issued. And that's why we are saying that the shares issued equally at the end of the year were 24. So this now will be our what? One-off weighted average number of ordinary shares. So having the two values here, the PATOS and one-offs, we have the PATOS here and one-offs here. We can compute the basic earnings per share using our formula. PATOS 36 divided by one-offs, which is 24. So this will give us what? This will give us what? This will give us shillings 1.5 shillings per share. Shillings per share. Okay. So we are done with that. Let's move to part B of the question. We move to part B of that particular question. In part B, we are required to compute the basic earnings per share for the year which ended 30th of April 2016. 30th of April 2016. So the formula remains the same, no need of repeating it there, because by the end of the day, the formula is not marked. It's basically for guiding you. So let's start by computing this one. The PATOS, and I think we can just compute this directly because we know how to compute that. We take the profit after tax minus the preference what? Dividend. So the profit after tax, or the profit for the year for 2017, is 185. And then to this, we less the preference dividend. Preference dividend is there below, where we have the statement of movement in reserves, which is also that. This will give us 31.55. That is the PATOS. Then from there we move and we compute what? The one-offs, weighted average number of ordinary shares. Now, what we know, in the second year, there are a number of transactions. Specifically, there are two transactions. In addition information number 1 and number 2. So what we need to do therefore here, we need to start by determining the shares which were issued at the start of the year. And actually we know that the second year started on, okay, remember this 2017, sorry. So this year started on 1st of May 2016. 1st of May 2016. So first of all, we need to determine how many shares had been issued by the company at the start of the year. And in this case, who can tell us how many shares had been issued by the company at the start of the second year? From what we know in 2016, shares issued at the start of 2017. How many shares were issued at the start of 2017? Yes. How many shares? Yes, it is obviously 24. The shares which had been issued and fully paid at the end of 2016, or at the end of the first year, are the shares issued and fully paid at the start of the second year. And also remember, these figures are in thousands of shillings. So then, if we go to the additional information, we have basically a number of transactions which occurred in the second year. So in number 1, we are told on 1st of November 2016, and this company made a bonus issue. What is a bonus issue? This means that the company issued additional shares to the existing shareholders of the company free of charge. So we are told the shares or the bonus issue was on the basis of 1 share. The company was to issue 1 share for every 6 shares which were held. 6 shares which were held. So in our case here, we know that before the company made this bonus issue, the shares which were held were 24. So therefore, the shares which were held before the bonus issue were 24. So we need to cross multiply, then we do what? We divide. So that will be 1 times 24 divided by what? By 6. Then you also have to recall that shares which are issued free of charge, they are not weighted on time basis. These shares, we don't weight them on time basis. And also number 2, these particular shares, we use them to restate the earnings per share for the previous year. And actually, that's why you can see in part C of that question, we are required to adjust the earnings per share for this year, because we assume these shares which were issued free of charge, they were issued at the start of the first year here. Sasa, yes. So, but here we don't weight them on time basis. So then in note number 2, on 1st of March 2017, we are told that this company made a right issue. Remember, we said that this concept here of right issue is very, very common. If you check on all questions for earnings per share, you'll see the examiner testing or this concept is tested. We say the right issue is what? This is the issue of additional shares to the existing shareholders of the company at a price which is below the market price. And therefore, because the shares were issued at a price below the market price, we have to split those shares into 2 components. Shares issued at full market price and the shares issued free of charge. And actually, we said for us to do that, there is a price which we have to compute, which is known as the theoretical X-right price. So therefore, the first thing we need to do here is to determine how many shares were issued by the company during the right issue, because automatically that is not given. So in note number 2, we are told on 1st of March 2017, the company made a right issue of 1 share, share for every 7 shares which were held. 7 shares. 7 shares which were held. So in our case, we need to ask ourselves, how many shares were held before the right issue was made? We said that one, you can't get it in the question. You can only get it from your working here. The shares which were held before the right issue, how many were they? How many shares were held before the right issue? How many shares were held before the right issue here? I'm told by Peshit Al-Kaib 28, to Khalid 28. Yes, they were 28. But recall what we said, that if, for example, these shares were weighted on time basis, what you do, you take the shares which were issued at the start here, and then you add the actual shares which were issued here. Because these shares may have been issued, may have been weighted on time basis. You take the actual, you add the actual. So therefore, the shares which were held before the right issue were 28. So we just cross multiply, then we divide. This will be 28 divided by 7. And I think this will give us what? 400. That will give us 400. 400. Okay. So having that, then we said there is something else we need to compute here, which is called what? The theoretical X-right price. Now, for us to compute this, there is some information which we need to have. Let's go back to note number 2, sentence number 2. We are told the right issue price was 8.5, meaning that this 1 share which was to be issued during the right issue, each share was to be issued at a price of 8.5. And then in the last sentence of note number 2, the last sentence of point 2, we are told the market value of 1 ordinary share on the date of the right issue was 12.5. In other terms, what that means is that the shares which were held before the right issue, they were trading at 12.5. So how do we compute the theoretical X-right price here? So we said we come here and we say that if before the right issue, remember there is a formula which you covered in a financial management, no need of cramming that. You just say before the right issue, if before the right issue you held 7 shares and each share was trading at 12.5, then during the right issue, you are to be issued with one share at a price of 8.5, So meaning that after the right issue, you'll be holding 8 shares. And what will be the market price of these 8 shares? So to get the market price of the 8 shares, we need to multiply this and this, which will give us 8.5. 7 times 12.5. Give me that figure here. 7 shares times 12.5. Times 12.5. That will give us what? 7.5. 7 times 12.5, which will give us 87.5. And then we add these two. It will give us 90 what? 96. Is it 96? 96. 96. Yes. So meaning that after the right issue as a shareholder, you'll be holding each shares. They'll be having a market price of 96. So what will be the market price of one share after the right issue? We take 96, which is the market price of 8 shares. After the right issue, divide that with 8, so that you get the market price of one share. Remember, we said that this theoretical right price, there is always a mark for this. Sasa? Yes. So having that, we come back here and we split our shares into 2 components. We determine the shares issued at full market price, and also we determine the bonus element. So how do we determine these shares? First of all, compute the amount received by the company from the right issue. The amount received will be equal to the shares which were issued during the right issue, which you have computed here, 400. Each share was issued at a price of how much during the right issue? 8.5 times 8.5 times 8.5. That gives us the amount received. Then divide that with the theoretical right price, which you have computed here, 12. And these particular shares, because they are shares issued at full market price, you have to weigh them on time basis. So they were held for how many months? The year was ending on 30th of April 2017. So the shares were issued on 1st of March. The shares were held in March and April. Are those 2 months only? Are those 2 months? So such that the proportion of time will be 2 out of 12. Is that the case? Are they held only for 2 months? March of 2017 and April of 2017? Is that the case? Yes, 2 months. And then from there, we determine the bonus element. The bonus element. These are the shares issued free of charge. How do we determine this? This is a formula. Take the total shares which were issued during the right issue, 400, minus the shares which were issued at full market price. We say the shares issued at full market price is not the answer you're going to get here, but whatever we have here. Actually, we say just transfer this here. 400 times 8.5 divided that with 12. And then we say that those shares, they are not weighted on time basis. They are not weighted on time what? Basis. On time basis. Yes. So this will give us what? First of all, give me the shares issued at full market price. 400 times 8.5 times 2 divided by 12. So you're getting what? What are you getting here? Yes, 47.22. 47.22. What about the bonus element? And actually, the bonus element, these shares, they are not supposed to be weighted on time basis. They are not weighted on time basis. That is coming to 116.67. 0.67. Okay. Yes. So that, I think that's what we have. Then I think in 20 or basically in the second year, we don't have other shares which were issued because in note number 3, we are told 8% convertible loan stock can be converted at the option of the holder in 2022. So there were none which were converted during the current year. Note number 4 is about tax. Note number 5, there were no preference shares which were issued. Note 6, no loan stock issued. So basically means that during this year, there was no any other transaction. So therefore, he said you must be able to deal with it, that particular concept of what? That concept of right issue. If you check on most of the questions for earnings per share, you'll see that is one of the concepts which does not miss. Which does not do what? Miss. So let's get the one else here, 24 plus 400 plus 47.22 plus 116.67, which is coming to 2963.89. 0.89. Is that what you're getting? That what you're getting? That what you're getting? Okay, so we take now the PATOS. Remember, we are applying this formula, PATOS divided by 1/0. This is our 1/0. So PATOS, that 155 divided by 2963.89. 0.89. So that will give us what? 3155 divided by 2963.89. 89. So which will give us shillings. Yes. Per what? Per share. So I think we are done with the part B of that question. Then we have part C, part C of the question. Part C of the question, which is also very, very simple. Part C, the adjusted, adjusted, which can also be known as the restated earnings per share for the year which ended 30th of April 2016, as it should be shown in the year 2017. So basically here what we are required to do is we compute the restated or adjusted earnings per share for the previous year, 2016. Now, how do we compute this one? This is a formula. We take the PATOS for 2016. The PATOS for 2016, we divide that with the 1/0 for 2016. And then out to this 1/0, what we do is that we add the bonus shares which were issued in the year 2017. Because we have said the reason why we restate the earnings per share for the previous year is because the shares which were issued free of charge during the current year, they are assumed to have been issued at the start of 2016. So in our case, we have these two values here. So the PATOS here, I think it was 36. The 1/0 for 2016, it was 24. So these figures these are the figures we have used in computing earnings per share for 2016. And then out to these 1/0, we are saying we add the bonus shares which were issued in 2017. So the bonus shares issued during this year. So first of all, we have these 400. We add them here. And then we also have this bonus element in the right issue. The bonus element in the right issue. That is 116.67. So what you do, you get the answer there. You get the answer. So that's how we compute the restated earnings per share. I think no challenge with that. Let's move to part B because of time. Because of time. So we are required to compute the diluted earnings per share. The diluted earnings per share. Now, diluted earnings per share, recall here we have 2 years. We have 2016, we have 2017. But in this case, I want us to compute the diluted earnings per share for 2017. Because you can see the examiner here was not specific on which year. So you can either compute for 2 years, but let's just compute for 2017, the second year now here. So we said in computation of diluted earnings per share, you follow 3 steps. 3 steps here. 1, you need to identify the potential ordinary shares issued by the company. What are potential ordinary shares? Potential ordinary shares, these are convertible securities issued by the company, or maybe stock options granted to the employees and which are to be exercised in the future. And then once we have done that, proceed and compute 2 items. Compute increase in earnings. Compute increase in what? In earnings, and also increase in number of what? Of shares. And then finally you compute the diluted earnings per what? Per share. So therefore, the first thing we need to do is we go through the information which are given in this particular question to angalia which potential ordinary shares was the company having in the year 2017. In this case, I'm saying you need to check which convertible securities which were issued by the company and whether the company had granted the employees stock what? Options. Stock what? Options. So that is the first thing we need to do here. We identify the potential ordinary shares which the company had in the year 2017. Potential ordinary shares or shares in 2017. So if we go through the information which we have, maybe starting from where we have equity and long-term fund, there we have ordinary share capital share premium, 6% preference share capital, retained profit, and then at the long-term fund, you can see we are given something called 8% convertible loan stock. Now, this is a potential ordinary share simply because it is a convertible security. The holders do have an option to convert it into ordinary share in the future. So I think that's what we have there. And then down here we have the income statement. What about in the addition information? In the addition information, number 1, I think you have dealt with that. Number 2, number 3 is the information about this, which you are told they can be converted into, or actually what you're given there is a conversion rate. Number 4 is about tax. Number 5 is about preference shares. Number 6 is about loan stock. And actually we are told there were no issue of loan stock in 2017. So basically, what does that mean? If we are told there were no loan stock issued in 2017, it basically means that the loan stock which had been issued at 2016 were the same as the loan stock issued in 2017. And I think in our question here, we only have one potential ordinary share. We only have one potential ordinary share, which is now the 8% convertible what? Convertible loan stock. So having identified that, step 2 is you compute something called the increase in earnings. The increase in earnings, and actually the increase in earnings, we know that this one is equal to the interest which was paid as far as these convertible loan stock are concerned. We multiply that with 1 minus tax rate. And I think this one is already computed. You don't need even to compute it. If you go to the income statement of the company, the income statement of this company, you'll see that the interest on loan stock is 80,000 actually. Is it 80,000? Yes, 80. So, but if that was not given, you take the coupon rate here, which is 8, and then you multiply that with the value for the 8% convertible loan stock, which is given as 1,000. That will give you what? 80. So therefore, the interest was 80. We multiply that with 1 minus tax rate. Tax rate is 30. So 1 minus 0.3. So this will be 80 times 0.7, which will give us what? 560. So that is now the increase in what? In earnings. And actually, in fact, here you can compute, we can compute diluted earnings per share for 2 years, 2016 and 2017, because there will be no change for this. We only have one potential ordinary share in 2016, 2017. Yes. Then step 2, or the other item we need to compute here is increase in what? Increase in number of shares. Increase in number of shares. So to compute the increase in number of shares, we need to have the conversion rate. The conversion rate is given in note number 3. The rate at which these convertible bonds will be converted into ordinary shares. In note number 3, we are told the 8% convertible own stock can convert at the option of the holder from the year 2022 at the rate of 125 shares. 125 shares for every shillings 1,000. For every shillings 1,000 of the own stock. So what we need to do here is we need to compute the number of ordinary shares which the company would have issued in 2016 if these convertible own stock were converted into ordinary shares. So the convertible own stock issued by this company, or which were issued by the company in the year 2016, and which is actually the same also in 2017, was it 1,000? Yes, was 1,000. But remember, these figures are in thousands of shillings. So we cross multiply, then we divide. So we take 12 times, not 12, but another 125 times 1,000 divided by 1,000. Is that the case? Yes. So this will give us 125,000 what? Shares, 125,000 shares. And I think now having that, we need to compute then the diluted earnings per share. So to compute the diluted earnings per share, you need to record the formula. So we take the PATOS used in the computation of basic earnings per share. To this, we add increase in earnings, which we have computed here. We divide that with the 1/0, and then to this, we add increase in number of what? Of shares, increase in number of shares. So we start by computing the diluted earnings per share for 2016. So what we will do, we will take the PATOS 1/0 for 2016. And I think we already have the PATOS and 1/0 for 2016 here, 36 and 24. And then to this, we add increase in earnings, which we have here, which is 56. And then to this, we add increase in number of shares, which we have here, 125. 120 what? 125. Yes. So that's basically how you're going to compute the diluted earnings per share for 2016. This is for 2016. For 2016. And also you will also compute the diluted earnings per share for 2017. What will only change here? What will only change here is what? Is the PATOS and 1/0. PATOS and 1/0. PATOS and 1/0. So remember these which abbreviations are you talking about here? Abbreviations. This basically this purely to guide you. The formula is not even marked. That is for guiding you. So therefore there is no those marks. So these are the items which are marked here. These are an increase in earnings. Yes. So that is, but you can just write that in full. You can't be penalized because of this. So these are purely for guiding you. What are marked are the figures. All these are to guide you. Yes. So to compute the diluted earnings per share for 2017, we are saying what will change is this and this. I think the PATOS, was it that 155? Someone to confirm for me. PATOS for 2017. Yes, it was that 155, and then the 1/0 was 29 what? 60, 29, 63.89. So and then the increase in earnings and increase in number of shares will not change, 56,125. Yes, so you get the answer here, which will be shillings per what? Per share. Shillings per what? Per share. Shillings per share. Shillings per share. Shillings per what? Per share. Shillings per share. Yes, so basically that is it, that what is required as far as that particular question is concerned. So I think for today, because of time, I want us to stop at that particular point. Once we meet tomorrow, I want us to look on maybe a question from deferred tax. So therefore, before we meet tomorrow, you can try to revise on that particular topic of deferred tax, and maybe we see whether we are going to look on maybe another question. I tried we look on a question maybe from impairment loss, and maybe any other area. So therefore, maybe before you meet tomorrow, try to look on those two areas: deferred tax and maybe impairment loss. Sasa, yes. So let's stop at that point for today. See you tomorrow as we continue with our revision. So have a nice evening. I want us to look on this particular question here, but basically we look on how this transaction was supposed to be accounted for by the lessee, and not the owner. The question is for December 2022, and specifically this was the question 1B. Question 1B. So we go through the question, we see what we are told, and the question reads, Fox Limited leased a factory to Tiena Limited with effect from 1st July 2022. And therefore here we said that Fox Limited is the owner of the asset, Fox Limited is the lessor, we looked on how the lessor was supposed to account for this risk, and therefore the other company here, that is Tiena Limited, this company is the lessee. So we are going to use the same information there. We are given the date when the risk commenced, the inception date of the risk. We can summarize that here. The inception date. Inception date here is 1st July 2022. Then from there, we also have the risk term, the period of the risk. There is a term. We are told the risk term are 4 years. 4 years. And then you're told the amount of the risk rentals payable is 4 million. So in other terms, what you're given there is the minimum risk rentals, which is 4 million per annum. And this one is payable in arrears. This one is payable in arrears. In arrears means that it is payable at the end of each year. And then you're told that the risk contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the risk term. Remember, you said that this particular information was given to us to enable us to know that this is a finance risk from the owner's point of view. Remember, you said now the lessee is not supposed to classify the risk as finance or what, or operating. So that information maybe will be relevant in our case here. And then we also given the interest rate implicit in the risk. That is now our R, which is 15% per what? Per annum. And then in this case, we also assume that you are required to demonstrate with suitable calculations the accounting treatment of the above risk transactions in the financial statement of Tiena Limited, who is the lessee. Who is the lessee? Basically for 4 years. So for 4 years. Remember now here what we said is that at the inception date of the risk, the lessee basically should recognize 2 items. One, the risk liability, and number 2, something called the right of use asset. So the first thing we need to do here is to compute what is called the risk liability, and then we amortize it, and then later on we compute the right of use asset, which we said should then be depreciated on a straight line basis. So let's first of all we determine the risk liability. We determine the risk liability, of which we determine this at the inception date. The inception date of the risk is 1st July of 2022. 1st July of 2022. And we say that this one is equal to the present value of the minimum risk rentals not paid at inception date. Not paid at the inception date. In other terms, we discount the minimum risk rentals which were not paid at the inception date. And basically, from the information of which we have here, this particular lease we know is for 4 years, year 1, year 2, year 3, year 4. And the minimum risk rentals which are payable by the lessee, we know is 4 million per annum and is payable in arrears. This is very, very important when this particular minimum risk rentals is payable. Is it payable at the start? Is it payable at the end? So this one is payable at the end of the year. So the first minimum risk rentals will be paid at the end of year 1, the other one at the end of year 2, the other one at the end of year 3, and the other one at the end of year 4. So we need to discount these minimum risk rentals because none was paid at the inception date here. So we discount these minimum risk rentals which were not paid here. So we take 4 million. Remember, these basically are annuities. We multiply that with the present value interest factor of annuity at the rate of 15% and basically for 4 years. So the formula which we apply here would be 1 minus 1 plus R. Our R is 15%, raised to power negative 4, N. Our N is 4. And then we divide that with R, which is 0.15. 0.15, 0.15, 0.15. 15. And I think this will give us the same value we got yesterday. Is that correct? We're going to have the same value as the one we got yesterday. I think we should have the same value. Should have the same value if I'm not wrong. Yes, are you getting the, are we going to have the same value as the one we got yesterday? Okay, so if you're not getting the same value, then give me the final figure here. What will be the present value of the minimum lease rentals not paid at the inception date? Yes, we try to hurry up, guys, so that we finish on time. Yes, I think we should be having the same value. 11 what? 419, 913. 9 what? 913. So this is now the lease liability at the inception date of the lease. At the inception date of the lease. And then what we said is that this particular lease liability here then should be amortized over the lease term. So we amortize this one by preparing something called the lease amortization schedule. There is amortization schedule. There is amortization schedule. Remember, this particular figure or this particular amount in the books of account of the owner of the asset, that is the lessor, we were referring to this as the net investment in the lease. Now, in this case, we are referring to this as what? As a lease liability. So this, in the books of account of the lessee, is a liability. In the books of account of the lessor, the owner of the asset, then this is basically an asset. So what we need to do is to amortize this one. So we amortize it by preparing the lease amortization schedule. And I think this will just be the same with some few changes here in our titles here. So we're going to have 3 years, not 3 years, rather 4 years. The first year here ended 30th of June, 30th of June 2023. The other one ended 30th of June 2024. The other one 30th of June 2025. The other one 30th of June 2026. Then what are we going to start with here? We are going to start with the lease liability at the start. So here we are not having the net investment in the lease, but we have the lease liability at the start of the year. At the start of the year. Then the other column which follows here depends with when these particular minimum lease rentals are paid. They are payable at the end. So meaning that the next column here will be for the interest. And in this case, this will be an interest expense. This will be an interest expense, which will be computed at which rate? At the rate of 15%. If you can remember the other amortization, which we prepared in the books of account of the lessor, we were referring to this as an interest income. This is an interest expense. And then here we will have a column for the minimum lease rentals paid. Minimum lease rentals paid. And finally, we have the last column here, which will be for the lease liability at the end of the year. The lease liability at the end of the year. So those are basically the columns you're going to have here. So the opening balance is what we have here. This one. And then we compute 15% of this. I don't think we have major change as far as these figures are concerned. What is only changing is what we have here. So just give me these figures from the amortization schedule we prepared yesterday. So what will be the interest here? Just type those figures for me there. This is the 1712. 1712, 987. So remember, the minimum lease rentals to be paid at the end of year 1 will be 4 million. At the end of year 2 will be 4 million. At the end of year 3 will be 4 million. And at the end of year 4 here will be 4 million. So how do we compute this one? The lease liability at the end of the year. We take this plus this minus this one. This plus this minus this. A plus B minus C. Minus C. What do we got? I'm saying you just give me these figures from the amortization schedule we prepared yesterday. Hapa tulikuwa na figure ngapi? What is the figure here? 91, 91, 32, 900. So that will be the opening balance here. What about the interest? What about the interest? The interest here? The interest. I'm only getting figures from Aisha. The rest you also need to participate. Akina Sarah, Akina Dominic, the more. I'm not getting answers from you. I'm not getting the answers. I'm given 13, 69, 935. What about the lease liability at the end of the year? The lease liability at the end of year 2. Lease liability at the end of year 2. Lease liability at the end of year 2, 6,502,835. That will be the opening balance here. 6502 835. What about the interest? The interest here is 975 425. Yes. So what about the lease liability at the end of that year? The lease liability here. Lease liability 34 78 260. So that now will be the opening balance here. 34 78 260. What about the interest? The interest for this year, 521 739. Yes, and I think now this one will be 0. The lease liability here will be what? Will be 0. Will be what? Will be 0. So that's basically how we amortize this particular liability. Now, before we prepare financial statement extract, next I want us we compute on we determine something called the right of use assets. The right of use assets, and actually we also determine this right of use asset at the inception date of the lease. The inception date of the lease. This is basically the date when the lease commenced. This is the date when the lease commenced here. And we say to determine this, basically we add three values. Majorly three values. One, we take the lease liability. The lease liability at the inception date. At the inception date of the lease liability on 1st July 2022. And that is what we computed here. What we computed here is 11,419,913. And then to this, we add payment, which was made at or before inception date. Inception date. The payment made before or at the inception date. Basically, we said that is the amount which was paid at the date when the lease commenced. Mostly, we say this is a price whereby the minimum lease rentals are payable. The minimum lease rentals are payable in advance. But in our case here, you can see we don't have any payment which was made at the inception date here. No payment. Equally to this, we said we add any initial direct costs, costs which are associated with the lease, e.g. the legal cost. Equally in this question here, we don't have such. We don't have any legal cost. Whatever you get here, that is 11,419,913. That is the right of use asset. And then what we do here, we then need to depreciate this. We determine the depreciation per annum for the right of use asset. And actually, we said that this one should be depreciated on straight-line basis at the shorter of two periods. The shorter of two periods. One, the lease term. So the lease term in our case, remember, are 4 years. And the remaining, or basically the economic life of the asset. Economic life economic life of the asset. Economic life of the asset. So if you check the information we are provided with here, I don't think we are given the economic life of the asset. There is nowhere we are given that information. So we only have the lease term, which are 4 years. So meaning that we're going to depreciate this right of use asset on straight line basis over a period of 3 years. So therefore, to determine the depreciation per annum, we take the value for the right of use asset, divide that with 4 years. Divide that with 4 years. That will give us what? That will give us what? That will give us what? The depreciation per annum. Before we look on, we prepare the financial statement extract. Yes, so this is giving us a figure for 2,854,978. So that is the depreciation per what? The depreciation per annum. Then what we need to do is basically now we prepare the income statement extract and also the statement of financial position extract. We show what was supposed to be recognized here as far as this transaction is concerned. So we are going to prepare this for 4 years. The year which ended 30th of June 2023, 30th of June 2024, 30th of June 2025, and 30th of June 2026, like that. So in the income statement, there are 2 items which were supposed to be recognized here. Actually, items of expenses. One of which is this one, the right of use asset, the depreciation for the right of use asset. We have depreciation on the right of use asset. And you're saying the depreciation would be 2,054,978 per annum for the next 4 years. So the depreciation here was 28,054,978. That will not change in the next 4 years. That will not change in the next 4 years. 28,054,978, 28,054,978, 28,054,978. That depreciation basically remained constant. It does not change. Then from there we have this particular interest expense. That this one should also be recognized as an expense in the income statement. And any form of interest, we recognize it here as what? As part of the finance cost. As part of the finance cost. So therefore here we're going to have something called the finance cost. And the interest for the first year, that is the year 2023, was 1712,987. Then for year 2, this one, 1369, 935. And then for year 3 is 975,425. And finally, we have this one, 512,739. So those are basically the various items of expenses which were supposed to be recognized in the income statement of who? Of the lessee. So these are basically the items which give you the marks. Then from there, finally, we need to prepare the statement of financial position extract. And basically, we show what was supposed to be recognized here as far as this transaction is concerned. Statement of financial position extract. Extract. So first of all, here we have 2 items. That is the first thing you need to know. We have 2 items which are supposed to be recognized here. One of it is the right of use asset, which I have computed here. We have to know that the original value for the right of use asset is this one, though we are saying that this one would have to be depreciated. And actually, I have computed the depreciation per what? Per annum there. So what we need to do at the end of year 1, year 2, year 3, year 4 is to compute the net book value. And actually, we know that to compute the net book value, we take the cost minus the accumulated depreciation. Number 2, the receipt in the statement of financial position will recognize whatever you have here. Whatever you have here, remember, is a lease liability. And actually, just like what we did in the other question we did yesterday, so this particular amount of the lease liability will have to be split into two. Part of it will be shown here as a non-current liability. Part of it will be shown as a current liability. I'll be able to show you how to do that particular split. But let's start by recording the right of use asset, which was supposed to be recognized as a non-current asset, right of use assets. And basically, you're going to have the right of use asset for over the lease term for the first year, which ended 2023, actually up to 2026, 30th of June 2024, 30th of June 2025, 30th of June 2026. So what we need to do is to compute the net book value. So how do we compute the net book value for the first year? To compute the net book value for the first year, we're going to take the initial value, the original value of the right of use asset, this one, and then we less depreciation for the first year. Depreciation for the first year. Depreciation for the first year. That will give us a net book value of how much? Will give us a net book value of how much? Will give us a net book value of how much? Net book value of how much? What are you getting here? Net book value of how much? So I'm given by Aisha say a figure of 8564. 8564, 935. And then now in year 2, so basically remember now this is the net book value at the end of year 1. So how do we get the net book value at the end of year 2? So there are two approaches you can use here. You may decide to take the original value for the right of use asset, and then you less the depreciation for 2 years. Because it's depreciation per annum, you multiply that with 2, so that you get accumulated depreciation for 2 years. You less it from the initial value, there, original value. So that will give you the net book value here. Alternatively, and which is now the easy approach, is you take the net book value for at the end of year 1, net book value at the end of year 1, and then you less depreciation just for year 2. That's for year 2. So you take this one, then less depreciation for year 2. Depreciation for year 2. For year 2, that will give us a value of what? That will give us a value of what? A value of what? What are you getting here? Is 5709 957 957. So we go to year 3. In year 3, we take this net book value at the end of year 2. We less depreciation for year 3. We less the depreciation for year 3. For year 3, we get the net book value at the end of year 3. Yes, the net book value at the end of year 3 will be 2854 979. And then to compute the net book value here, we will take this one minus depreciation for year 4. And that will give us what? That will give us 0. That will give us 0. That will give us what? 0. So therefore, that is how we compute the net book value, the net book value of the right of use what? Asset. So then from there, we need to proceed and we record this lease liability. Remember, you have said this lease liability is supposed also to be recognized here as a liability, but in this case, I've said this lease liability must be split, must be part of it will be recognized here as a current liability, part of it as a non-current what? Liability. So under the non-current liabilities, we are going to have something called the lease liability. The lease liability. And also under the current liabilities, we are going to have something called what? The lease liability. The lease liability. The lease liability. So how do we determine the amount here to be recognized as a lease liability under the non-current and current. The concept you used yesterday when you were determining the amount of net investment in the risk to be recognized as an non-current and as a current, we are using the same concept here. For example, at the end of year one, we can start by determining this. The risk liability to be recognized here as a non-current liability. At the end of year one, the amount to be recognized here as a non-current liability should be the risk liability at the end of year two, this one. So this one will be recognized as a non-current liability in the year 2023. Then in the year 2024, we take now the risk liability here, the risk liability at the end of 2025, which is 34,78,260. And then at the end of 2025, we take the risk liability at the end of 2026. In this case, you can see it is 0. At the end of 2026, we should take the risk liability at the end of 2027, which we also know is what? Is 0. So that is how we determine the amount of risk liability, which should be recognized here as a non-current liability, as a non-current liability. Then from there, what do? We proceed and we determine the amount of the risk liability to be recognized here under the current liabilities. Remember, he said current liabilities. These are those particular liabilities which are payable within a period of one financial year. So, and therefore, he said the amount to be recognized here as a current liability, this is the amount of the risk liability to be paid within the next 1 year, of which we say that should be the difference between these two values. So give me the difference between these two values here, and that is the amount of the risk liability to be what? To be recognized as a current liability here, That will give us what? What are you getting here? The difference between these two values here. Risk liability at the end of 2023 and 2024. I'm given a figure for 9 something. 900. Is that correct? I don't think so. That should be 2 million. 2 million 26 30 065. The same case now, at the end of 2024, we take the difference between the risk liability at the end of 2024 and 2025. 2024 and 2025. What is the difference between these two values here? The difference is 3 million 575. Yes, and in 2025, we get the difference between those two values, which will be 34,78,260. And then at the end of 2026, we should take the risk liability, the difference between the risk liability at the end of 2026 and 2027. That is 0 and that is 0. So meaning that the risk liability there will equally be what? Be 0. Will equally be 0. Yes. So this is basically how 𝐎𝐍 is accounted for in the books of account of who? In the books of account of the receipt. And actually, now in this case, we say the marks which are allocated to such a question. Basically, these are the items which earn you those particular those particular marks. So basically, by preparing the income statement extract, you show what was supposed to be recognized here as an expense. We have said 2 items: the depreciation of the right of use asset, and this one, the interests. And then here you show what was supposed to be recognized as an asset, what was supposed to be recognized as what? As what? As a liability. Yes, so that is it. That basically what was required as far as that question there is concerned. And I think that is all about that question there. Now, finally, what I want us maybe we pick a question on cash flow. And maybe we do it very, very fast here, because I think that should be our last area of revision. So I don't know whether there is any question you have attempted on cash flow. Maybe you want us we do, or maybe we attempt it here. Kuna swali watu wame attempt on their own, or we can just pick any. Is there a question you have attempted on cash flow, on group cash flow? Yes, any question you have attempted? Okay, so we can pick any. 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 Yes, so I think we can just pick like this one for August 2022. August 2022. So there is a question I can see there. August 2022. This was question number what? This was question number 5. Specifically number 5 what? Is it number 5? Yes, so this was question number 5. Question number 5B. Question 5B. Question 5B. Yes. So let's do that question. Maybe we start with part A. So this theory, I think we also did this in class. It reads, in context of IFRS 9 financial instrument, describe 2 criteria that must be fulfilled in order for a financial instrument to be categorized as classified in the category of amortized cost. So I think what in our case we did, when we were looking on the classification of financial assets, remember in this case we talked about 3 categories of financial asset. One, we talked about the financial asset at fair value through profit and loss, and which we said that these are basically, or these are an investment in equity instrument for speculation or for trading purpose. So we said that if a company has acquired shares for speculation or has invested in shares for speculation or for trading purpose, then that is a financial asset at fair value through profit and loss. So number 2, it also talked about financial assets at fair value through other comprehensive income. And also we said that this is an investment in equity instrument, but the entity intends to retain the ownership of such shares on a continuing basis, or the entity here intends to retain the ownership of those particular shares for a long period of time. And therefore, we said that this is a long-term what? Investment. Therefore, what we said is that these financial assets, they are recognized in the balance sheet or in the statement of financial position as a current asset, whereas these one are recognized as a non-current asset. Then we also talked about the financial asset at amortized cost, of which we said financial asset at amortized cost. We said this is an investment in debt instrument. Investment in debt what? Instrument. And equally what we said is that for any financial asset to qualify to be classified as a financial asset at amortized cost, then we said it has to meet 2 criteria. 2 criteria, and that is now what the question was asking about here. So the criteria which must be met by a financial instrument, whether it is a financial asset or basically whether it is a financial liability, for it to be classified as what? For it to be classified in the category of amortized cost. So here we talked about 2 criteria. One of it was something called the business model test. The business model test. And number 2, we talked about something called the cash flow. Cash flow characteristic what? Test. Cash flow characteristic test. 1, we say that for a financial asset to pass the first test, the business model test, and therefore be classified as a financial asset at amortized cost, we said the objective of the company in making that investment, the objective of the company investing in the debt instrument should be to correct, or in other terms, to receive the cash flows which are associated with such a financial what? A financial asset. For example, in this case, what we said as an individual, if, for example, you invest in treasury bonds of the government, treasury bonds issued by the government, maybe having a life of 2 years, usually your main objective in making this particular investment is to earn interest in the next 2 years, and then at the end of the second year, you are given back your principal amount, the principal amount which you invested. So mean that your main objective in making this particular investment, in investing this particular, or in investing in this particular treasury bonds, having a life of 2 years, is to earn or to receive cash flows associated with this particular financial asset. And the cash flows which automatically you're going to receive will be the interest. And also at the end of the second year, you are given back your principal amount. So therefore, for any financial asset to pass this particular test here, then the objective of the company in making that investment should be to correct or to receive the cash flows associated with such a financial asset. Number 2 here, we talked about the cash flow characteristic test, and we said for any financial asset to pass this test, the cash flows which are received by the company must be in form of interest and also in form of principal amount. Like in this case, we know that once as an individual you have invested in treasury bonds, having a life of 2 years, then in the next 2 years, you're going to earn some interest, of which we know the interest, in relation to these treasury bonds issued by the government, the interest is basically payable semi-annually. After every 6 months, you'll be paid some interest. At the end of the second year, you'll be given back your principal amount. So meaning that the cash flows you are receiving is in form of interest and also in form of principal amount. And therefore, if a financial asset basically passes these 2 tests, the business model test, the cash flow characteristic test, automatically it qualifies to be classified as a financial asset at amortized cost. And that is what was required in that question. By explaining those particular 2 criteria, those 2 tests, for each test, you get how many marks? You get 2 marks. So let's move to part B of that question, which reads, W Group has owned a number of subsidiaries in several years. The following information related to the financial statements of the group. First of all, we have the consolidated statement of financial position, basically for 2 years, 2021 and 2022. We have the non-current asset, current asset, we have equity, non-current liabilities, and current liabilities. Then from there, we have the statement of profit or loss and other comprehensive income, basically for the year, which ended 31st of March 2022. And then from there, we have additional information, number 1 up to note number 8. So what are we required to do here? We are required to prepare the statement of, or the consolidated statement of cash flows using the indirect method for W Group for the year which ended 31st of March 2022 in accordance with IAS 7. Remember what we said is that once you come across such a question in an exam setup, we said you have to appreciate the fact that you have not more than 40 minutes to be able to tackle this particular question and basically be able to proceed to the other question. So therefore we said 1, never start with the workings, because we said that one of the big mistakes which majority of the students do, and they end up failing this particular paper, is maybe starting with the workings. We said those workings are not marked, they purely waste a lot of your time. So we said any working which is required, you do it per need basis. There is something you want it to compute it, post it in your cash flow, and make sure it is earning a mark. But don't compute something, then you leave it there, you are not using it in your cash flow. So compute or do all the workings per need basis. And therefore, what we said is that once you come across such a question for group cash flow, what you do, you go straight to the working. You go straight to preparing what is required, not to the workings. Go straight to preparing what is required. And in this case, we are required to do what? We are required to prepare the consolidated statement of cash flows for this group. And the name of the group is W Group. W Group. This is the consolidated statement of cash flows, which is for the year which ended 31st of March 2022, 31st of March 2022. So once you have that title, then we said next you proceed And you have now the three subheadings, because we know that when preparing a statement of cash flows, we have to determine the net cash flows from three activities: net cash flow from operating activities, from investing activities, and also from financing activities. So we should have those subheadings here. We start by determining cash flows from operating activities, and here we need to have two columns. And I think our figures which are given there, the figures we are given there, they are in what? They are in a million of shillings. We need to indicate that here, that our figures will be in million of shillings. So then here we said leave some enough space, and then you have the other subheading. So remember here we said we have so many items which you record there. So therefore make sure you leave enough space. And then from there, you have the other subheading for determining the cash flows from investing activities. Remember, you said investing activities here. These are those activities which involves acquiring assets and also disposing assets, acquiring subsidiary, and also disposal of what? Of subsidiaries. Yes, equally here we are going to have two columns, and our figures are in million of shillings. So then leave some space. Then down here we have the last subheading for determining the cash flow from what? From financing activities. And if you can be able to record, we said that all the items which you record here, we get them from equity and non-current liabilities. Equity and non-current what? Liabilities. Equity and non-current liabilities. And finally, down here, what do we record? Down here, we record something called the cash and cash equivalents. The cash equivalent balance brought down. And also that is balance brought down, the opening balance. And then we also record cash and cash equivalents balance carried down. Balance carried what? Down. And actually what we said is that always start by recording these two items, because these are free marks. Remember, what we said is that mostly this particular question for group cash flow, for any correct entry which you have here, mostly you get 2 marks. With an exemption of some questions. There are some questions which do have so many entries. Like I think there is a question which we did in class for April 2022. We say that question had so many marks. So in terms of how it was marked, for every correct entry, you are getting 1 mark. But most of the recent questions for cash flows is that for any correct entry which you have here is 2 marks. So meaning, for example, for this question, for you to get the 20 marks here, you just need to get 8 correct entries, because you can see the marks allocated there were 8. You just need to get 8 correct entries. So if you get 8 correct entries here, you're able to score all the 16 marks. The other thing which is also important for you to know is that any correct item which you record here, how many marks? 2 marks. Sasa? Yes. So let's do that and we start by recording the cash and cash equivalent at the start and also at the end. And remember, in this case, we said when talk about cash here, we are talking of cash in hand. Cash in hand. This also include cash at bank. This also include the bank overdraft, the bank OD, bank overdraft, and maybe something called the short-term investment. Short-term investment, recall, we say that this can also be known as a financial asset at fair value through profit and loss. So you add all of them. So where do we get the cash and cash equivalent at the start and also at the end? We get this from where we have current assets and current liabilities. And once you go to the current asset, these are the items you check for. Once you go to the current liabilities, you just check for one item, bank overdraft. Sasa? Yes. So can we go to our statement of financial position, specifically where we have current assets? So under the current asset, what do we have? in this question here. So you can see the beauty with this particular question. The examiner has already given us the cash and cash equivalent at the start and also at the end. Now, the cash and cash equivalent at the start of the year, which basically should go to the last column, is 160. And remember what we said is that anytime you come across a question for cash flow, you'll be given the statement of financial position for 2 years. You can see the current year was ending 2022. You'll also be given this one for 2021. We said the figures which are given here are opening balances. The figure we have here are closing what? Balances. Sasa? Yes. So therefore, the cash and cash equivalent at the start, we should not take 160, but rather we should take that in the statement of financial position for 2021, which is how much? Which is 344. 344. So in that case, you can see the cash and cash equivalent. This one is not given. Sorry, this one is already given. This one is already given. This one is already given here. But I've said if it was not given, ordinarily what the examiner will do, he will give you these items. The cash in hand, cash at bank, bank overdraft, short-term investment. You just add all of them. So, and then we also have now the cash and cash equivalent at the end of the year, which is what? Which is 160. So basically what this means is that if, for example, for every correct entry, you are getting 2 marks, then we already have 4 marks there by just recording cash and cash equivalent at the start and also at the end. Then from there, because now we are using the indirect method, what we know is that when computing this cash flow from operating activities when using the indirect method, so always here we start with the profit before tax. The profit before tax is something we get from the income statement. So can we go to the consolidated statement of profit or loss? Consolidated statement of profit or loss, and you give me the figure for the profit before tax. How much is the profit before tax? Give me that figure. I see whether we are together. Profit before tax is how much? I'm told by Regina is 1464. 1464, is that the profit? Yes, that is the profit before tax. That is the profit before tax. 1464. And then we said to this particular profit, or basically we said we make a number of adjustments to this profit. And the first adjustment made to that profit always is the finance cost. Finance cost, we said, is always above this profit. So, and how much is the finance cost? The finance cost, you can see that figure. The finance cost ni ngapi? Finance cost is a figure for how much? For 184. 184, yes, 184. 184. So the reason why we add this one is because when computing this one, the cash flow from operating activities, ordinarily we should start with the profit before interest and tax, or the operating profit. But are we given that profit before interest and tax? No. What we therefore we do, start with the profit before tax, and then you add back interest. Interest, remember, is also known as a finance cost, such that now we have the profit before interest and what? And tax. Now, even before we move away from the income statement you're given there are also a number of items we need to adjust to this particular profit here. And one of it is the share of profit of associates. I hope you can see just above this profit, there is something known as the share of profit of associate. Share of profit of associate. How much is that figure? That is basically a figure for 128. You can see in arriving at this figure here, this share of profit of associate has been added, but basically this one, we less it from that profit. The reason being that this is a non-cash item. Remember, whenever the parent company has invested in an associate, this is basically what we know from the normal consolidation. Whenever the parent company has invested in an associate, what the parent company recognizes in the group account, in the group statement of profit or loss, or in the consolidated income statement, is the group share of associate profit after tax. But is that the amount of money which the parent company see from the associate? No. So therefore, this is a non-cash item. That's why basically we let it here. And then from there we said, as far as the associate is concerned, we should come here and we compute something called the dividends received from associate. The dividends received from who? Associate. And actually, we said to compute this dividends received from the associate. There are a number of items which we consider here. We go to the consolidated statement of financial position. Can we go to where we have the consolidated statement of financial position, specifically where we have the non-current assets? Under the non-current asset, you can see we have something called the investment in associates. The last item here, investment in associates. So that is what we use in computation of the dividends received from what? The associate. So to compute the dividends received from the associate, hoping there is nothing else which will affect this. So we said we do what? We take the investment in associate at the start of the year. The investment in associate at the start of the year was 0. And then to this we add. So automatically here, this particular investment was acquired during the current year. Let me see. Yes, this particular investment was, this associate automatically was acquired during the current year. So automatically we can't be able to use this particular approach. But generally we said in computing this, in case the subsidiary, the associate was not acquired during the current year, what you do, you take the investment in associate at the start. Like in our case, we can see it is 0. So we can't be able to use this approach. And then plus the share of a profit from associate, which we had in the income statement. This one minus investment in associate at the end. So automatically in our case, we can't use this information. So we have to go to the additional information. Let's first of all keep that. But first of all, this particular amount should be deducted from this. Then dividends received from the associate should be recognized here, because once the parent company has acquired an associate, that is an investment. That is what? An investment. So is there anything else we can capture here from the income statement? I don't think so. So unless first of all we go to the notes, then there is something also I want you to note from the income statement which you are given there. You can see, first of all, we are given something called the continuing operations. And down there, I hope you can see we have something called a discontinued operation. There is a question we did the other day in relation to the disposal of interest. And in this case, we said when talk about a discontinued operation, we are referring to what here? What is a discontinued operation? Who can be able to remember from that question we did for group accounts, where we had a subsidiary which was disposed? Yes, in this case, we said that when we talk about a discontinued operation, we said that this is a subsidiary which is fully disposed. Is a subsidiary which is fully what? Disposed. This one is referred to as a discontinued operation. And therefore, what we said, if, for example, the parent company had, for example, subsidiary 1 and maybe subsidiary 2, and the parent company has fully disposed this one, has fully disposed subsidiary 2, this one will be deemed to be a discontinued operation. And therefore, when the company is preparing the consolidated income statement, what the parent company should do is to take the revenue for the parent and the revenue and expenses of the parent plus the revenue and expenses of this what? Subsidiary, and determine the profit or loss from continuing operation. This will be regarded as continuing operations. And then later on, the company will have to determine the loss, the profit or loss from this subsidiary which was disposed. And I hope you can see that is what is accounted for there. Just like what we did in the other question. I hope you can see what the company has done, has computed the profit for the year from continuing operations. And then from the discontinued operation, we have the loss for the year from discontinued operations here. And automatically that loss includes the loss on disposal and also the loss which was reported by that particular what? Subsidiary there. Okay. So let's go to the additional information. We see whether there is something else we can be able to capture here. And you can see now also here we have three other entries. Here in total, we already have how many entries? 5 entries. So meaning that if the marks allocated per entry are 2, it already means that we have 10 marks. Do you have the question with you? If yes, please confirm. Please confirm. I can see we have 1 hour, 20 minutes. We must finish this particular question here. We must finish that question. Okay. So what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? At A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent, and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax and other comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital block limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary, Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAR. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets, the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what? Year. We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told LOC Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? the goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCH fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit. Basically, by applying this formula here, we will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 all over 5. So this one will be the margin, will be 1 all over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in Caesar were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2, paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1, paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that point number, paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and lock limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically, what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically, what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on the 1st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share Prof. limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 marks. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always have 3 marks. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 14 what? 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa, yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a 3 mark. Income tax expense. Income tax expense, also this one, is always a 3 mark. A 3 mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case, we are done, and that what was required, the marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE. And then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase consideration which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent. under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, we are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They will consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. we are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam, and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is 𝐿𝐿, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of 𝐿𝐿, that 380. For paper, it is given as what? 1,800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute the retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track variable, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and it is profit that will also be deducted from the retained earnings of paper 50, like that. Like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 38.60, which basically will give us 93.60. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now, to compute this, very simple. We take the NCI at fair value, the NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share log the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No, it has to be deducted there. So we add these two values and they give us 940. So the NCI fair value here is basically 940. But basically I'm saying although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. $10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be. Is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92, 70. And the retained earnings should be 30, 37, 50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, this is an expense which the parent company was supposed to have accounted for. The parent company needed to recognize this as an expense, and that's why you can see in the income statement, the parent company didn't have a finance cost. That was supposed to be captured here, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned, and I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account, in relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it, because now what I want us to do once we meet in our next class, we are looking now on special cases in group account. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday,